This is Rick Rule on behalf of everyone at Rule Investment Media and the Rule Classroom, the Rule Symposiums, and the Rule Newsletter, wishing all of you the very best of the season. Happy holidays, happy whatever you like to call it, Christmas, Hanukkah, best of the season to you and yours from all of us. We've had a spectacular 2025. In terms of our programming, in terms of our markets, in terms of our growing share among customers like you. It's been a delightful 2025, and I'm convinced that 2026 will be even better in every regard. Our programming improves, our audience increases, and our market is in an upward trajectory. It has been lovely serving all of you for the past year. It's been lovely corresponding with all of you for the last year. It has been Lovely watching all of you interact at the classroom and at the symposiums, in the boot camps. We look forward to a lot more high quality content, a lot more audience participation, and we look forward to a very, very, very supporting market. Once again, from all of us, all of the staff at Rule Classroom and Rule Investment Media, to all of our audience, best of the season. Thank you for a spectacular 2025. And we look forward, pardon me, to an even better 2026.
All right, and welcome everyone to the stream. That was Rick Rule with his holiday greeting. I'm Albert Liu with Adrian Day and Steve Barton for this holiday live stream, guys. It's great to see you. How's the holiday been?
It's been great for me, and I'm sorry, I'm going to call it Christmas. So I hope everybody had a wonderful Christmas. I hope you enjoy the rest of the Christmas season, and I had a great Christmas. Thank you, Albert.
Is Christmas not a holiday where you are?
No, there's all this stuff about happy seasons and all that sort of stuff.
The politically correct, yes.
Yes.
How about you, Steve?
Oh, wonderful! Yeah, I'm out in Vegas right now with the family. We spend Christmas every year out in Las Vegas, so it's a lot of fun.
Really?
Always stuff to do. A great town.
Yeah. I'll just mention this. I'm down in southern Brazil in a town called Gramado. It's a place where a lot of Brazilians go to spend Christmas. If anyone ever is in that area, it is magical at Christmas, just magical. You know, we've got rockets, we've got beautiful women dressed up in Santa costumes, we've got nativity scenes, we've got everything. It's a beautiful place for Christmas.
Awesome. What's the name of the town?
It's called Gramado.
Gramado. Okay. I've been to Brazil, but I haven't been there. Okay. All right.
No, it's way down in the south near Uruguay.
Okay. Cool. Good deal.
Oh, interesting.
Looks like we're
Is
getting
that a regular destination for you, Adrian?
Well, my girlfriend's parents retired here, so yeah, the last few years I've been coming down here.
Oh, okay. All right.
Yeah.
That's cool. That's cool.
Maybe next year I'll do Vegas and you do Gramado, Steve.
There we go. We'll trade. Getting a lot of people filtering into the comments here. Looks like we got Doppelganger, Steve, Barry, Bubba Knight. Merry Christmas, everyone. Thank you guys for being here. Mark, good to see you guys. I bet you guys have seen gold and silver lately, huh?
Absolutely.
Gold is over 4,500. Silver is almost $77, just rocketing higher. It's happy holidays for sure, man. That is impressive. Have you guys heard anything about the arbitrage that's going on right now with silver and with Shanghai?
Not enough to talk about.
Okay. Yeah, we've got Rich Checan lined up later on. Maybe he can comment to that on the physical side.
Okay.
That's where the stress always shows up, right? It's when the physical side starts to sort of enforce some kind of actual discipline on the market. I see a lot of comments coming from YouTube. Where are our Rule Classroom folks? Are they hiding out today, or what's going on with them?
Let's see. Supposed to be logged into YouTube because we're there in Twitter only. Okay, maybe we need to connect the classroom. I'm not sure. Yeah, it looks like everything's coming in from YouTube. What's up, Mark? Good to see you. Eric Young and Vince Lancy, they covered it well. Okay, yeah, I was starting to listen to Mark, to Vince and Eric, and they were talking about the arbitrage that's going on right now between Shanghai and New York in the silver market, but I didn't get the whole interview. But yeah, interesting.
Well, we got a fun day planned. We'll see who actually shows up, but we had a lot of interest in this. I think up first is going to be Rich Checan, Javier Reyes from Luca Mining is going to show up. I want to ask him about sort of the politics of Mexico and how he sees that developed over 2025 and what he thinks is in store for us next. And then Brian is traveling. So a lot of people traveling, obviously, over the holidays. Brian London's going to try to join us from wherever he's hiding out, some cabin or something like that in Louisiana. He's going to try to join us. Nomi Prinz is scheduled to come. And then Joe Mazumdar is going to be having his normally reserved for Rule Plus members, but he's going to be doing his lecture today at 12.
So, great.
Should be a lot of fun.
That's 12 Pacific, just to be clear.
12 Pacific. Thank you, Adrian. 12 Pacific. So great year, guys. I just want to take the opportunity while I have you both to thank you for your contributions to the classroom. Rick laid out sort of the business case pretty succinctly. It was a good year. Frankly, I was surprised. Like, I don't know about you guys, but I remember being in New Orleans, not 2025, 2024, and people asking me what I thought, what I expected for the specifically the commodity price in 2025. And, you know, the fundamentals have been in place for a long time. Like what's happening now has been set up over several decades. So the fundamentals were telling me that it's just going to keep going up. But because I'm a gold bug and I know that God doesn't like me, I just didn't think it was going to happen. Like I couldn't bring myself to say it. And so this year was a very pleasant surprise, although, you know, there is sort of a dark shadow behind all of this, which is the dollar. But I was surprised. How about you guys? I mean, this is phenomenal.
Yeah, I was, you know, I thought that we would be moving up. I just didn't think that it would be quite so parabolic. You know, I mean, like today, silver's up 7%. And it doesn't look like there's any sign of it stopping. You know, I didn't expect quite such the parabolic move. You know, that's what surprised me is how quickly the hockey stick is going. You know.
Yeah.
What about you, Adrian?
I think the biggest surprise to me, to be honest, is not so much the price that we're at right now, but it's the fact that we haven't had a correction. I mean, we just haven't had a pullback for the last, the last 12 months. We had that sideways from April till August, but you know, no pullback, and that to me was very significant because it means it indicates that there's a lot of buying on the sidelines, and there are not perhaps particularly weak hands at the moment. And of course, we have the other factor in this parabolic move in October, November, December. Well, I should say November, December, the parabolic move. We've got a new buyer, right? Tether. Maybe we can talk about that later with someone. Rich might be a good guest for that, but you know, that is extremely significant, I think.
Yeah. Now, Adrian, you're a veteran in this market. Be honest, did that sideways make you a little nervous?
No, I would have been much more comfortable if we had had a real correction, if it had gone down 15, 20% and been down there for 2 or 3 months. So does it make me nervous? And you saw the same thing in October after the October 20, was it 20 or 21 peak? We had a drop, and that lasted what? You know, a few days, and then it started moving back up again. So, you know, I'm surprised we didn't see a deeper, but more importantly, I'm surprised we didn't see a longer pullback. It just shows there's a lot of people on the sidelines. You know, and it's a funny thing. People who don't buy at 2,000 because they want to buy at 1,800, and they won't buy at 2,200 because they'll buy at 2,000. You know, and they won't buy at 3,000 because they want to buy at 2,500. Somehow, when it goes from 44 to 4, they jump in. And I think I think we just got so much pent up buying, waiting for an opportunity.
Yeah. I had a friend that did exactly what you're talking about. Is he got caught up in. When it was down around 1,800, he got caught up trying to get it at 1,825, and just never got in. It went to 1850, never hit 1825. He sold a house. And so he was asking me, what should I store this in? And he's like, I feel like if I put it in dollars in the bank, they're going to get inflated away. I'm like, that's a very good point. And he said, well, where do you think gold will go? I'm like, I don't know. Maybe it'll go down to 1825, somewhere in there. It's like 1850 right now, and he ended up trying to pick up nickels in front of a steamroller and just never got in. And now we're at 4,500 and he's still got the same money in the bank that's not paying him any interest. I mean, I think at some point, you just kind of have to take a position and throw your hat in, and maybe don't jump all in with 2 feet, but at least get your feet wet so that, it'll run away on you,
Well, particularly with gold itself. I mean, I think with the stocks, you need to be a little more disciplined for sure.
Yeah, for sure.
Guys, I've been asked that question for over a decade now by people who don't own gold. Say, well, should I buy? Is this a good time to buy? And this is going all the way back to like 2010 or before, early 2000s. And the answer is always the same. It starts with, well, how much do you have now? Because the price doesn't really matter so much if you have none. And all you have is a bunch of cash.
Sure.
You know what I mean?
Sure.
So, yeah, because too many people have been burned on that. Really.
Yeah.
And why you're buying, obviously, Albert. I mean, if you're buying for insurance, if you're buying for savings and insurance, the price doesn't matter. I've said this to so many people. When buy a new house, do you hang around for a year or two waiting for a good price on your flood insurance? I don't think so. I think you buy it because it's insurance. And maybe if it's expensive, you buy a little less, or not such a good policy because you can't afford it. But you don't wait for a good time to buy insurance. Sorry?
Yeah. In that case, you should buy less house, actually, if you can't afford the insurance.
Well, that's a different subject.
Yeah. I mean, it's just an indication that you're in over your head, right?
Yeah.
Guy, it's interesting. I was thinking about this the other day. Gold, if you look at it, because you can look at it over like almost a quarter century now, and look at the compounded internal rate of return. It's high, guys. It's like double digits. And so, Adrian, like as a money manager, that has to affect what you consider the risk-free rate now, right? I mean, forget the 10-year treasury.
No question. I mean, if you look at, you mentioned the last 25 years, but I mean, just look at last year. Gold is up 72%. The S&P is up 19%. So you have to ask yourself, has the risk reward changed?
I can discard 1 year, right? I can discard 1 year and say, well, that could be anything, right? That could be the meme stock phenomenon,
Well, yes, but the meme stock phenomenon meant you should not buy meme stocks. But you're right. I mean, it's been 1 year, 3 years, 5 years. It's been 25 years. So gold is actually outperformed.
Decades now. You look multiple decades now. Gold has proven itself.
Yeah, but that's a reflection of the decline in the purchasing power of the dollar and other fiat currencies, isn't it?
Yes. So what it means is your nominal returns. I mean, I guess people have not fully processed sort of the inflationary contribution to their nominal gains. They've just assumed it's like 2 or 3% or something like that. Even in the GDP numbers, when they use the deflator, people are assuming it's down there in the 2s and 3s. But if gold is rising at double digits, it tells a completely different story about what these gains really are. You're just treading water. Even if you're at 9-10%, you're just treading water.
No, I think that's right. That's right. But again, it's a reflection of what's happening to fiat currencies. And if you look around the world, it is very difficult to pinpoint any country, any I was going to say meaningful country, any major country where the currency, where spending is being controlled and the currency is not depreciating.
Yeah.
Yeah.
Yeah. I mean, because these systems are all linked. And so if the US is inflating, it's very difficult for any other region to sort of ride independently of that because of all the debt relationships and whatnot. It could really, really cause a lot of problems. But just from an investor standpoint, I think we have to really consider choosing our yardsticks carefully here, because what you think is good performance may actually be quite poor performance. And I liken it to like thinking you're in a race car and being passed by a tumbleweed on the highway. Gold's if you're not outperforming gold, there's something wrong. There's something seriously wrong.
I was looking at, I was measuring gold and silver versus the average price of a U.S. home. And if you had essentially saved your wealth in silver, housing is like 20% the cost that it was only a few years ago. The average U.S. home cost like 24 or 25,000 troy ounces, and now we're in the 5,000s.
Wow.
So housing has gotten really cheap compared to, everyone thinks, I think, that housing's in a bubble and it's high priced, but if you saved your wealth in gold and silver, it's actually really cheap. And I think it's going to get cheaper. It takes less than 100 ounces now to buy an average U.S. home of gold.
Yeah, you're talking nationwide averages, right? I think
Yeah.
I think we just get carried away with headlines that focus on hot areas and stories about people who speculated with leverage, right? With gold, we're generally talking unlevered cash on cash kind of return. The people that did well in real estate, they invested in hot areas, and they used 5 to 1 or greater leverage, and of course that's gonna boost your returns. Obviously, it's not even a fair comparison.
Yeah. Got a few comments here. Steve in the chat says, could we be seeing cash flows into precious metals that used to go into crypto? That's interesting. I plot Bitcoin, and Bitcoin has definitely been taking it on the chin since October. It's down, I don't know what percent, probably, what is that, 20 or something? No, about 35% since October. That would make sense. I mean, I guess the crypto crowd is probably very similar to the precious metal crowd, in that you're trying to store your wealth outside of the system. So if that hasn't been doing well and gold and silver have been going up, I could see there might be some cross-pollination there. I haven't actually researched it.
Well, me neither, but people in the industry, and then also just, anecdotally, would tell you that it's been going the other way for many years at this point.
Yeah.
I think the motives of people invest in each are similar, distrust of the system broadly, and specifically the monetary system. But it strikes me, for the most part, the type of person that buys crypto is different from the type of person that buys gold. I mean, of all of my clients interested in gold, I mean, maybe 4 or 5 have asked, maybe I can buy 1 or 2% in crypto for them. And I suspect that the same is probably true largely of crypto people. But so I think the motives are much the same, but the characteristics of the buyer are different. But look, there's no question in my mind that if you see crypto, if you see Bitcoin down 50 or 60%, I'm sure you'll start to get some very significant flows into gold.
Hey guys, sorry to interrupt, but our first guests have arrived. So let me welcome to the stage Javier Reyes, who is the founder of Luca Mining. And our friend Rich Chekin. Rich, we were just talking about you. How are you doing?
I'm doing pretty well. Hopefully it was good.
Good to see you.
Good to see you.
What's up, Javi? How you doing?
How are you guys?
Good. You?
I'm doing amazing.
Good. Rich, good to see you.
On a day with 7% silver, it's always nice, no?
Not a bad day.
Yeah.
How was your Christmas, guys? That's for you, Adrian. Rich, how was your Christmas?
He's asking you two.
Yeah, no, my Christmas was fantastic. It was much smaller than normal. You know, the kids are growing up, our friends and families are growing up and spreading out. So instead of hosting 25, we had 7. But a very nice surprise because my daughter is a nurse in Norfolk and she wasn't supposed to make it home. And Christmas Eve, we went to Mass, we came home, we're ready to sit down to dinner, and the front door opens up. Fantastic surprise.
Oh, wow. That's nice.
That's cool.
That's nice. And how about you, Javier? Where did you spend Christmas this year?
I was in Mexico, and on the 23rd, we had a Christmas party at the mine site, just to share with all our team this year that has been very special. And then on the 24th, Mexicans celebrate Christmas on the 24th, not on the 25th. So we had a lot of family being together for the night on the 24th. So yeah, it was a really family-oriented Christmas. So thank you for asking.
That's one thing I love about Mexico. Like the people I know who own businesses in Mexico, which is only a couple, but they go back to have parties with it's kind of an essential thing, right? And go back to have a party with the company because the company is like family. It's great. It's a great thing.
And actually, they value a lot that you are there, no? Because as you know, we have 24-hour shifts. So most of the employees, they have to be working at the mine site all day long, including Christmas and New Year's Eve. So to spend time with them, and I took my kids and my wife, and actually my father was there as well. So yeah, it was, and this year has been very special. So, I mean, for us, as I shared with you many times, Albert, the most important asset we have is our people, no?
Yeah.
And we have an amazing team, and I have had the opportunity to share this with Steve as well many times. And the team that we built over the last 20 years, it's incredible, no? And we try to have maybe 98% are Mexicans, and particularly we operate all over the country. But I was in Oaxaca. That's the place I decided to be, which is mostly a silver mine, and most of the people are local. And Oaxaca is one of the poorest states in Mexico. It's very south, getting into the border with Guatemala. So like ourselves spending time with them, it makes a big difference, no? And my kids had the chance to go underground, and it's an underground mine. So yeah, we had an amazing day on the 23rd with them.
Great. Can I ask you, Javier, jump right into it. Tell us, how do you see the environment for mining in Mexico right now? How has it changed this year? And not just at the government level, but also, you mentioned you're in Oaxaca. I think, correct me if I'm wrong, but I think some of the states in the South have not always been so supportive of mining as some of the other states, like Sonora, obviously. How are you seeing the environment for mining now?
Well, first of all, it's very true what you said. As you go south, it gets more complex, no? And socially complex. And particularly Oaxaca is very socially complex, since you have 500 counties in one of the smallest states in the whole country, right? So, and they all have a strong beliefs, some of them not very pro-mining. But I guess very fortunate for us, Fortuna Silver was operating in that state. So now we're the largest operation in the state. But before, it was Fortuna Silver, and most of the money that they use to buy rocks, gold, and grow in Africa now, it came from that specific area where we are neighbors, and we own most of the concessions around the former San Jose Fortuna mine. So they did a pretty amazing job in convincing the people to accept mining, no? Because again, they did have a strong belief against mining, and I mean, some of the security issues that we have in Mexico, we don't have them in Oaxaca. It's more like a socially complex rather than the other things you hear about Mexico that happens in Guerrero and Durango, and like the other security things you hear. So that's why for me it was very important to spend Christmas with them, because it's all about people, no? And they do value ourselves being there. And we took control of that operation as the previous management in a way, bankrupt operations 18 months ago. So, and then Fortuna left. So there was a lot of movements in the state because Fortuna leaving and ourselves taking control. But I think now it's very stable. But going back to your question about Mexico, as you guys know, we had 6 really bad years, no? And then we had a new president, a woman that took office over a year ago. And I guess, and I would answer this mathematically, the reason the country has changed is because there's a limit to what you can do if the budget is against you, no? So 6 years that the government was anti-everything, of course anti-mining, but also anti-everything. Things have changed, first of all, because the new president is not as bad, but second, because the budget, Mexico is financially broke, no? So then, as you don't have the same cushion in the balance sheet to continue doing or paying for people's votes, you have to start having the private sector on your side. So I would say that we have 2 things in our favor as miners. Again, first is the new president, but most important, now they really need the private sector to help. And then the US has, very fortunate for Mexico, the US has built the most pressure we ever experienced as a country. And as you know, the most wanted cartel leaders, I wouldn't say in Mexico, but in humankind, that they unfortunately were all Mexicans, they are now in US custody, no? So, and that has built tremendous pressure for Mexico to turn to the center. Because I guess you guys can imagine the amount of information that these leaders have, that they've been doing illegal activities and in a way pushing politicians or bribing politicians. This is like a 60-year journey, you know, and it's for the first time that every single one of them is in US prisons. And I think that in combination with ourselves being economically weak has forced Mexico to turn center and to start focusing more on security and rule of law. So the what I can share with you, and as you guys know, I'm very, very close with the government, and we've been part of all these new regulation and these roundtables with the Congress and with the government. The last being 2 weeks ago, that we had our largest mining event in the country, which was in Acapulco. So the Secretary of Economy of the country was there, Marcelo Ebrard, and the head of mining, Fernando Boitis, was there, as well as a few governors and undersecretaries. And what I can say is things have changed dramatically compared to what we experienced 6 years. So I guess you guys are aware that we had the first permit north of the country, which was with Silver Tiger. But what is going to be very relevant is there's 2 open permits that will happen very soon. And again, I was just with them last week on the 22nd, to be precise. And I believe that there's 2 huge permits coming, no? And of course, strong evidence of it. One is San Nicolas, which is a massive open pit in Zacatecas, and Cordero of Discovery, which is again an open pit, will come very soon. So I don't know if it's going to happen during January, but it's going to happen very soon. Q1, we should have these 2 open pit permits, which the message is very strong, because it's not just saying Mexico is pro mining again, but this stigma on open pit, as you permit 2 massive open pits, will go away. So what I would say is that Q1 will be very important, and hopefully for PDAC early March, Mexico will permit this and things will change. So for the speech, the Secretary of Economy, again, 2 weeks ago when we planned this important event for Mexico, he started his speech saying, how can we be against mining if everything starts at a mine? It doesn't matter what business activity, everything starts at a mine. So, and of course, for him to go on record with that powerful speech, because it was longer to what I just said, he had to have the authority of the president to go on record, no? Because we had governors there, we had all kinds of different people related to mining. So I think, again, we learned the lecture as a country, and then these two permits that I shared with you will make a hard statement for the public market. And I would say after that, there's several others, including Google. Google should get their permit very soon, and other very small ones. But at not these huge permits, of course, are really very relevant. But for other permits like drilling permits, other kinds of environmental permits, tailings expansions, we all have seen a big change, and the permits are happening very soon. So the head of mining, Fernando Voigt, is as well, he's being very pro-mining. And I would say that, again, the statement will come in the next few weeks when we have San Nicolas or Discovery online.
Mm-hmm. Mm-hmm.
That's fantastic news.
Yeah, it's, go ahead, Albert.
Oh, I was just going to say, like, you identified kind of a common pattern there, right? Where necessity sort of at some point forces things to move along, but the pendulum often swings, and then when there's good times again, policy reverts. So, do you see any indication that this could be sort of a lasting reform, that that it's not just another swing of the pendulum in one direction only to swing back?
You know what? It's hard to tell, right? And it's going to be very important what happens in the US, because the person that has pushed Mexicans to the center, it's being the US, no? As Trump came extremely aggressive against Mexico. And again, you can imagine the amount of politicians that are in the list that these cartel leaders in costume in the US released to Trump, right? So when Trump has to negotiate in Mexico, there's actually no negotiation. No? Basically, the way it goes is, if you don't do this, these are the consequences. No, so when you negotiate, I mean, they have every single governor, secretary, congressman, and they have been actually canceling US visas, no, of all these idiots on the left that own real estate in Miami, New York, that have accounts in the US. So if the US continues its way, the pressure will continue to be built into Mexico, because Mexico is the #1 supply chain for the US. So Mexico is the country that buys and sells the most goods to the US, no? So we are a bigger partner than Canada or China, and that makes a big difference, no? Because the US might not care what happens to Cuba, or now they're caring about Venezuela, but Mexico is different, right? Because all your supply chain is south of the border, and things, if something happens to Mexico, then it's a big difference, no? You have millions of Mexicans going north, which is not what the US wants, no? So I think, I mean, even at our places, you see drones, US drones flying on top of our mine sites, which we never saw for years. It's the first time in our history that we've seen military presence in Mexico, and again, that's a very strong statement on where Mexico is going, and politicians have kept quiet and not complaining, no, that they are violating our sovereignty. So I didn't. I mean, very important. We're going to have midterms ourselves in Mexico, and as long as we start going towards the center and not to the left, I think we have a big opportunity into the next cycle. So the Secretary of Economy is meant to be the next president of the country, no? And the Secretary of Economy is he comes originally from the center, and he is the one who has really helped negotiate with the president to release these huge permits like San Nicolas and Discovery. So I guess to feel better about the future, we have to know who is the candidate on the left, because the left, unfortunately, most likely will win again. And the reason being is because in the very poor areas of the country, which is more than 50% of the country, they unfortunately control the votes, not because people wish to vote their way, just because, I mean, the cartels and the left, they control those votes. So again, but I think the US hopefully will help us be more towards the center, and these statements happening in the country, not only in mining, but in the different industries that we are big and we are partners with the US. You see the same signal, and actually, for the guys that don't know, we are going through the renegotiation of the North America Free Trade Agreement again, no, and we fortunately will be able to include a special mining chapter, and that will make a big statement, no, because of course for Canada more than the US, it's very important. And there's lots of complaints about mining as part of the North America Free Trade Agreement. And there's lots of multi-billion-dollar arbitrations as part of the existing agreement we have. So First Majestic has a big arbitration, like over $1 billion, Silver Bull. I mean, there's lots of them, no? And having a special chapter that will fast track any dispute as part of the agreement also sends the signal that it's relevant for the three countries, no? And I think Trump has made the statement that securing commodities is a #1 priority for the US, and the only country that can actually source the commodities in Mexico, no? So even though Mexico has a lot of issues in terms of rule of law, corruption, and many other things, and a left government, it takes 50% of the time to permit a mine that's what it takes in the US or Canada, no? Even though we are not the best country because of the reasons I just said. So also Mexico is now in recession, no? And the only industry that is not in recession, or one of the only ones that is not in recession, is mining. So and we operate in the very, very poor areas of the country, and I do feel now like Oaxaca is one of the poorest states where we operate, and you see the difference. Like at the end, people need to eat, and people value what we do for them, and the salaries we pay are more than average. So I think in combination of everything, this should help us have mining as a priority for the country. And the last thing I would say is Vulcan, which is the biggest arbitration the country has. Vulcan is a US company, and I have a strong evidence and facts, and I've been part of the conversations where, for Donald Trump, that issue, he starts the negotiations with Mexico with the Vulcan situation, no? Because what the country did to Vulcan, it was probably one of the worst things that we have done as a country, mining wise. And those meetings that we have as part of the renegotiation of the agreement starts with Vulcan, no? Because they are close to the Republicans, they are close to Donald Trump. So I mean, now mining is always part of the discussion, and I think these combinations of these different things that I just mentioned should help us like push mining forward, no? And there's concessions being granted as we speak, which they didn't grant for 7 years. So I think there's many things happening, and all are positive compared to what we were 6 years ago.
Great.
Thank you, Javier, for those comments. I want to change the topic slightly here and go to silver. Rich, we've been waiting to ask you this question. Steve and I were on a call before the stream, and he was talking about silver prices in Shanghai, the physical market just going crazy. And it seems like these stresses show up in the physical market due to, hoarding, but in the case of silver, due to commercial applications as well. So what are your thoughts on the reports coming out of China?
And refresh my memory.
Well, just
specific
like
reports. I mean, there are lines around the block around metal. I know that.
Market.
Go ahead.
Just reports of $80 an ounce on the physical market in Shanghai, and that there's a shortage basically of physical silver. That you, like I said, when there's stresses, and we see it here, when there's stresses, they show up in the physical market, and then all of a sudden the quote doesn't mean anything because there's nothing to be had. And so I don't know, just your thoughts on that, or just in general, like what's going on with silver?
Yeah, well, the situation is very, very good for silver. There's no question about it. And we've been talking about this for a long time, and we're finally seeing the price catch up with the narrative, if you will. Michael, my uncle, started the firm, 40 some odd years ago. He just got back from a around the world trip. He was in China. He was in Hong Kong. He was in Australia, and he could testify to what you're hearing, that there are lines around the block to buy precious metals. This is something we saw here in the States back in the 80s. People buying positions forward in line so they can get their metal quicker before the price got higher, for God's sakes. So that is happening. There's no question about it. I don't think we're at a point where we're running out of silver at this point, but let's face it, those who have it, when there's incredible demand, have the ability to control that demand by raising the price, right? They can make a more profit, or they can calm the crowds down because they can't afford it anymore. I don't think that's the problem with silver. I think people are going to be able to afford it no matter where it goes to in the short run. We had, I want to say it was 11 years of excess production, surplus production. And then we've had 5 years now of deficit production. And I think the first 2 of those years canceled out the first 11 of surplus production. So the supply demand equation is a good one for silver. Industrially, we continue to see that demand grow, whether it be with solar panels, this, that, or the other. And I think Samsung just came out with an announcement about the use of silver going forward. They're buying up, I forget the name of the mine, but they're buying up the mine production for a year.
Silver Storm.
Yeah, there you go. Everything that comes out of that mine is theirs because of the applications they're looking to use silver for. And let's face it, gold, it's still, I think, got plenty of room to the upside, but it's almost $5,000 an ounce. We're trading about 4,500 right now, and people are saying, $10,000 is just 2 ounces of gold. I can control some silver if I go that direction, and it's still a precious metal. So whether your argument is monetary metal or industrial, or just supply-demand equation, it's good for silver, and I think we're going to see much, much higher prices. This is long overdue, in my opinion.
Yeah. Are you still seeing, when we talked in New Orleans, Rich, you were mentioning that junk silver, constitutional silver, the silver dimes and half dollars and quarters, are they still selling at a discount compared to, like, let's say, Eagles or?
Yeah, they are. It's not as severe a discount. When we talked last, the junk silver, so that's pre-1965 U.S. quarters, dimes, half dollars, they're minted 90% silver content. And of course, they're not making any more of them. And the coins they produce today have no precious metals content in them. So people buy and sell that junk silver for the silver content. When we last spoke, that was selling below spot silver. I can guarantee you it is not any longer. Okay. It's slightly above it, though. The reason there's still a lot of junk silver to be bought is you got to understand that is only available in the secondary market. So as the prices ratchet up, right, we hit a new high, and people that have been holding on to that for years say, I'm going to get rid of it now. I can make a profit. Right. So a bunch of them sell it onto the market until the point where they've exhausted everybody that's going to sell at that level. And then there's nothing more to be had. And then price ratchets up again. So right now we are in a mode where we're ratcheting up in price, and new customers are coming onto the market saying, hey, I'm going to take some profits here. I'm selling it onto the market. So the wholesalers still are pretty flush with junk silver, and therefore they can sell it at fairly low premiums, although I believe we're not selling it below spot right now.
Okay.
Does that make sense?
Yeah. So I guess what I'm getting at is, if let's say you're a kid and you've got a bunch of silver bars, could you actually get more silver by trading that for some constitutional silver?
I don't think so. For the
Okay.
for the premiums involved to buy and sell the bars, to buy and sell the junk silver, I don't think you're going to basically eliminate that gain.
Okay.
Yeah, it's hold what you got right now. If you don't need it, ride it higher and buy some more, in my opinion.
Okay.
Yeah. I mean, we got that 45-year cup and handle formation, right, that we broke out of. So we knew that that's a fantastically bullish formation. It's been building up stress and energy for so many years, and it broke out to the upside, which suggests much higher prices. I think the parameters of that cup and handle, I'm not a technical trader, suggest $90 to $100 silver. So I think bare minimum, that's where we're going. I think a lot of people are getting very optimistic and calling for much higher prices, but I think 90 to 100 is fairly safe. I'm not a cheerleader. I don't have the legs for it. So.
And you know, Rich, even at that price, it would still be trading at only 50% of its CPI adjusted price from 1980.
Exactly. And
So
that's why
there's
a lot of
definitely
people are calling
room.
for higher. Yeah.
Yeah. And I think for one thing about silver that I think is very important for people to realize is that unlike gold, there really are not a lot of stockpiles that are ready to come to market. You don't have central banks holding it who could sell. You don't have an awful lot, stashed away. Obviously, in the 80s, a lot of people melted down, the Georgian silver and so on. But I get the feeling that I get the sense that there's not a lot of that happening right now. And the other thing about silver, of course, is very important to understand is that the price signals from an increase or decrease for that matter, but the price signals from changes in demand to changes in production are very, very tenuous. I mean, with any metal, it takes time, right? With, if the price of gold triples or quadruples, it takes time before you can increase your gold production. But you get a signal. With silver, since most silver, something like 75% of silver is byproduct silver, and a lot of that is small amounts, like 8%, 10% of a zinc mine in Peru. Well, as I've said before on our podcast, Rich, the zinc miner in Peru does not decide to build another zinc mine just because that 8% byproduct has doubled in price. And so the price signals you don't get a supply response. There's no direct supply response to higher prices.
Yeah, that's a fantastic point, Adrian. It's supply inelastic. You don't have a lot of pure silver plays. There's no two ways about it. You need somebody to want something else in order to get more silver out of the ground. And the other point you made about central banks don't hold silver, there's not big stockpiles. I mean, if you look back, I think central banks gave this precious metals bull market about a 3.5 to 4 year head start in price action before investors got into it. And we've talked about this as well in our podcasts and elsewhere, Adrian, that, for me, it was very clear that investors were not in this market, not just because I'm a dealer and I could see that more people were selling into it rather than buying into it. But, you look at the gold silver ratio. All right. When that thing starts coming down, it means that silver is being bought. That means investors are in the market because central banks don't do it. It's too bulky. They rather deal with gold. It's a better tier one asset for them to hold. Silver is the domain, if you will, of the investor and of industry. So, until the investors were involved, you weren't going to see that gold silver ratio come down. It stayed 80 to 90, got up to as high as 127, but it was 80 to 90 for about 3-4 years. And everybody's like, when is this going to start? Well, guess what? It started. And it's very obvious. I think today the gold silver ratio is down below 60. And that happened very quickly. And we're not done yet.
Oh, wow. You're right. I'm looking at it right now. It's 58.7.
There you go. Well, 7% in a day might do that for you when gold.
Yeah, no kidding.
So.
Well, Rich, let me ask you this, and then I'd maybe like Javier to comment, because he's involved in silver as well. But when you look at the price of gold right now, and you've said gold still has more room to move, but from a point of view of you advising a client who says, hey, Rich, what should I do?
Yeah.
Are you recommending people trim their gold and add to silver as well as platinum and palladium?
I think that the time to basically take your silver and parlay it to gold is when we get down to like 35 or to 50 to 1, somewhere in there. The time to have moved your gold holdings into silver was back when it was up at 90, right? So if the way I look at it, and you know this, Adrian, I look at metals for two reasons: wealth insurance and profit potential. When it comes to wealth insurance, for me, that's gold all the time, every day. It's a steady eddy. It just marches in time. It preserves purchasing power, and it's where you want to hold your rainy day fund, your emergency fund in precious metals. So that's always gold, and I never sell unless I have an issue. When it comes to profit, I absolutely weight that towards silver. I love the fact that it dips deeper in a bull market and rises higher in a bear market, and rises higher in a bull market. I love the fact that we have a wider pendulum swing and a greater profit potential, and we're starting to experience that in this bull market with silver now. So I'm still a buyer of silver here. When it gets down to that 35 to 1, I might be parlaying some of that over to gold to store that purchasing power going forward.
Okay.
So
Javier, obviously, Mexico is one of the largest countries for producing silver, and you have a lot of primary silver mines. Are you seeing a lot of primary silver mines in the pipeline? And what does it mean for world supply?
So what I would say, Adrian, is my only, I would say, concern is that, this is only about Mexico because this is the only statistics that I know. Our gold mines, it doesn't matter if gold rises 100% like it has done the past several months. The extra supply of gold is very limited. No, it doesn't go above 1% year over year. It doesn't matter that prices have risen pretty aggressively. But that's not the case for silver. No, as you see prices of silver going up in a fairly aggressive way, now you see a lot of mines that were shut down in the country for years coming online again, and you see the increase in supply, which by definition, I mean, as the supply increases, then you might have price decreases in the coming years. No, which again, for gold, you barely. I think Mexico will produce less gold this year compared to 2024. It doesn't matter that prices have risen. Of course, we have the issue about permits and many other things. But for silver mines, many silver mines that were basically junk assets for many years, now they have been pushing production. And so that's my only, I would say, concern and difference between gold and silver. I mean, you brought the stockpile issue. I mean, gold has huge stockpiles, but it doesn't move the price. No, in the case for silver, when the stockpiles start to rise, it does affect the price, and we see it in the country. So I was with the CEO of Fresnillo just a few days ago, and even their own mines have been really pushing into increased throughput, and zinc mines, other types of mines that have as byproduct silver, they have to go back online just so that they can produce the silver while prices are high. So I guess that's my comment on Mexico.
Okay. Yeah, Mexico, I think, produces around a little less than 25%. So a little less than a quarter of the world's silver comes from Mexico. Correct me if I'm wrong, but I believe that's right. But I also think I'm right in saying that Mexico, a much larger percentage of Mexico's silver comes from primary mines than, say, if now Bolivia also. But if you look at the US or Canada or other jurisdictions.
Correct. So like these old silver mines, again, they are back online. Like La Negra is an example that exchanged hands like 6 times over the last 10 years. Now is finally producing. And most of our primary mines, like our mine in Oaxaca, it used to be 40% silver. Now it's like 60% silver, no? Because it's a silver gold mine, and it's a primary silver mine now. So many of the mines now are becoming primary silver just because prices are getting us there. And yeah, I mean, I've seen activity that I didn't see in maybe 15 years, since maybe 2010, which we didn't have permitting issues. We just have price issues on silver. But now, I mean, you see lots of silver activity and people rushing into these mines, again, even without permits, because I don't think we're going to have like silver mines, primary silver mines being permitted over the next few years.
Hey guys, sorry,
Okay.
but it's time for our next segment, so I'm going to have to conclude this discussion. But Javier, I want to thank you a lot for joining us this morning. I really appreciate it. You as well, Rich. Thank you so much for your comments. Good to see you. You know, Rick in his announcement, which I'll play again at the beginning of the next segment, he talked about what a great business success and market success we've had this year, but we've also had a lot of fun. I really enjoyed the personal interaction with all of you folks this year and just putting out the content and just getting people informed. So I want to thank you for that, guys. It's been wonderful working with you this year. So thanks, and I look forward to 2026.
It's mutual, Albert, and best wishes for 2026. It's going to be a lot of fun next year too.
Yep.
Thank you, guys.
So
Happy New Year.
Javier Reyes
Thank
with
you.
Luca Mining. Javier actually in next year is going to be going under the microscope with Rick Rule in our next Do Your Diligence. Javier, as the founder, and Dan Barnholden, the CEO of Luca Mining, are going to get grilled by Rick. It's going to be something you really want to see. So watch out for that. That's for Rule Plus members. Javier says he's ready. So it's gonna be really good. And then Rich, of course, is with ASI, Asset Strategies International. Rich, how long has that company been around? It's founded by your family a long time ago.
Yes, 82. So we're starting our 44th year. So
Yeah,
I've only been here 30, so I'm the new guy.
He's the new guy. Asset Strategies International, great company. I love doing business with them, guys. Thank you so much for joining us. And like I said, look forward to next year.
Thank you. Bye.
Thank you, guys.
All right, Adrian and Steve, I don't know, are you guys signing off now? Are you able to stick around? We are going to bring on our next guests, Hunter and Brian.
Yeah, I could stick around for a bit.
Yeah, no, I have to go at the end of the first hour, so I need to.
Okay. Well, Adrian, thanks so much for that and making me look bad with a hat. I thought if I had green and red, I'd be in the spirit enough, but look at these guys.
Okay.
Jolly indeed.
Well, listen, thanks everyone, and good wishes for the new year.
Yeah, you as well. Safe travels, Adrian.
Okay, thank you. Thank you.
Cool.
Oops.
This is Rick Rule. On behalf of everyone at Rule Investment Media and the Rule Classroom, the Rule Symposiums, and the Rule Newsletter, wishing all of you the very best of the season. Happy holidays, happy whatever you'd like to call it, Christmas, Hanukkah, best of the season to you and yours from all of us. We've had a spectacular 2025 in terms of our programming, in terms of our markets, in terms of our growing share among customers like you. It's been a delightful 2025, and I'm convinced that 2026 will be even better in every regard. Our programming improves, our audience increases, and our market is in an upward trajectory. It has been lovely serving all of you for the past year. It's been lovely corresponding with all of you for the last year. It has been lovely watching all of you interact at the classroom and at the symposiums, in the boot camps. We look forward to a lot more high quality content, a lot more audience participation, and we look forward to a very, very, very supporting market. Once again, from all of us, all of the staff at Rule Classroom and Rule Investment Media, to all of our audience, best of the season. Thank you for a spectacular 2025. And we look forward, to an even better 2026.
All right, and that was Rick Rule, guys. And I feel like Rick is watching us right now, so I better do a commercial for the symposium. 2026 is just around the corner. The Rule Symposium will be back in Boca Raton again this year. It's always a lovely time. And if you register now at symposium.rule.com, ruleclassroom.com and use this discount code RuleCheer. You can save $25 off the registration. That is until the end of the year. Looking forward to this next segment. Look, there is a man underneath the deer in the bottom left-hand corner. Joining us now, Brian London, president, host of the New Orleans Investment Conference and president of Jefferson Financial, and Hunter Moteri, who works with Lobo Tigre in evaluating companies for his newsletter, The Independent Speculator. Gentlemen, welcome to our holiday live stream. I think now that Adrian's gone, I'm going to call it the ambiguous holiday live stream because I know he would absolutely hate that. Guys, thanks for spending time in your holiday to be with us. How are you?
Doing great. I'm disappointed I scared Adrian off. I've never seen Adrian with a Santa hat on, and that was quite the experience.
Oh, he's got a lighthearted side, for sure.
I've noticed over the years, yeah.
Hunter, how are you?
I'm doing good. I can't complain. After the past 3 months, how can anybody in the sector complain?
Mm-hmm.
Yeah, that's the thing. So, Hunter, we were talking before you came on about your experiences this year. You talked to a lot of companies as well as a lot of investors. So you have a real boots on the ground feeling for what goes on in the trenches. And one of the things you said is that obviously, there's a lot of enthusiasm. People are very happy, but also this sort of paranoia or disbelief. So tell me, what are you seeing in the market?
So everybody I speak with is nervous. You buy these metals and you wait for this time, and then it comes here and you're almost in disbelief, right? Silver's up, 150%. I don't know what it is after another 7% day, $8 day, whatever, So I went, this includes me. I'm getting nervous here. So I talked to a friend of mine who manages some money, and I was explaining some of my concerns, and he cuts me off and he says, "Man, you're like a battered wife." He said, "For the past 15 years, your husband's come home every Friday and he's given you the business. Well, you've left him, you found a new man, and now on every Friday, you still expect him to come home and beat you." He said, "But this time it's different." He said, this is not the metal. This is not the market that you want to try to pick a top in. And as we were talking, he said, "Just do me a favor." He said, "Take a screenshot of the silver chart and invert it." He said, "Would you buy that stock?" And I said, "No, it's a falling knife." And he said, "Exactly. So just try and stay level-headed and just hang on for the ride." Now, it's very hard to do when silver's gone from 50 to 70 as quick as it has. I mean, and the most of this move for silver has been in the past, like I said, 3 months. So this is my first experience of the Doug Casey euphemism of, squeezing the contents of the Hoover Dam through a garden hose. And it's surreal. It really is. I'd love some wisdom from you guys that this isn't your first rodeo.
Brian, before you guys came on, we were talking about, the year in gold and the pullback. We lost close to 10% or something like that for a while there off the high. Mm-hmm. And I asked Adrian, did that make you nervous? Because, he's been around for a while. He's seen these markets, right? I mean, I don't know if I believe him. He said no. He said, "I would have been happy if it went down more, but you get a reversal. And in our market, that thing could last like a decade. You could be like another ice age, cold winter for another 10 years. So what were you thinking, Brian, when we topped and reversed for a little while? Did you expect this sharp rebound? I mean, this is quite extraordinary.
Well, I have to say I expected a sharp rebound because that's been the characteristic of this market. We've had not the typical corrections that you would have in a typical bull market for gold, because central banks have been, well, at least initially, they were driving the bus. They started the bull market. They precipitated the price rise. And now I think they're more of a supporting force underneath the market. But this has been a unique bull market in the history of gold as an investable asset because of the central banks buying strategically and not, along those the roller coaster ride that individual investors usually go on when they buy through emotion, to the despair and euphoria and back and forth. So we've had a very consistent rise. We've only had 10% drawdowns. The first due to Trump's election and rumors that there was going to be a Bitcoin reserve replacing gold, and that didn't last long, and gold popped right back up. This last drawdown was because the Western investors finally got involved toward the end of the summer, and they drove the market to kind of a euphoric peak and then backed off. And that's why we had the drawdown, but it was only a 10% drawdown. It wasn't the typical, 20 or 25% drawdown that gold has experienced in previous bull markets. And that's because the central banks were supporting it on the downside. So I did expect another rally. I did expect it in mid to late December because from a seasonality standpoint, that's been a typical time frame. Did I expect what we're seeing now, this kind of a bounce back? No, and I don't think anybody has. We spent much of the summer trading sideways in that kind of correction that's been typical for this bull market. And over that period, it was interesting to me that participants, the battered wives of us in this market, like Hunter was referring to, we kind of got accustomed to $3,000 gold. That was what we thought gold was going to be above for some time. And that's not bad. For junior miners, some miners, that's incredible. So we got used to that. Then all of a sudden we had to get used to $4,000 gold, $4,500 gold, yada, yada. And that's the kind of a thing I don't think anybody expected. Even the most ardent gold bugs, even the ones with the biggest tinfoil hats on their heads, never dared to predict this kind of a move this quickly. So yeah, I think we're right to be nervous. I think gold is telling us something here. I think silver is telling us something slightly different, but it's telling us something as well. And in this kind of a market, Hunter was asking, what do you do in this kind of a market? Well, the lesson I had painfully taught to me in the 90s, early 90s, and then kind of taught again, but I learned my lesson in the 2000s, is that when you get the kinds of capital gains that we're seeing, you have to treat it almost as an income flow. You have to dip a ladle into those capital gains, take them out of the market, not just into cash in your brokerage account, but out of that account too. Put it into something. Gold and silver, I think, even though they're on such runs, are great ways to save wealth, ensure wealth. Put it into something productive, put it into real estate, something out of the market. Just take a little bit of those profits. You can still, when you get gains like this, when your stocks are going up 3, 4, 5, and you have 10 baggers along the way, you can afford to take money off of the table and take it completely out of the market and remain involved still in a very significant way in the market. So I think people need to start thinking about that. That said, that's great advice to give, but I found it really hard to take because it's an exciting time, and the mining stocks in particular are just really getting started, and in some cases, like today, can't even catch up to the metals.
Yeah. The silver is up. I'm looking at it right now, up 8% right now, 8.3, and
That's
some
incredible.
of the leveraged silver plays aren't even up that much today. So
Yeah.
it's like you need a little bit of time for people to wake up and figure out how to bet this,
Yeah, I remember silver going up 8%, and that was like a 50-cent move or something. It was not like what we're seeing right now. These are crazy times. And I alluded to the fact that silver's telling us a bit of a different story. It occurred to me over the past few days that this is the first time in history where silver's industrial usage has actually been to its advantage. And this is the first time in history where industry has actually had to bid against investment for silver supplies. because there's always been ample silver supplies before. When I started following the market, decades ago, there was over 1 billion ounces of surplus silver above ground. And even as the silver price went up to this last peaks of $50, when photography was still a big part of silver usage, you could still recycle in photography. So it really didn't affect it that much. Right now, because of the supply constraints we've seen develop over the past year and even couple of years for silver, industry needs silver. It's a very small component of the end price of anything it's used in. So they have to get silver, they have to buy it. And right now they're competing with investors for whatever's out there. We've never seen this before, and that's behind what we're seeing right now.
Yeah, I really like your comments about, making sure that you kind of pay yourself along the way. I was talking about that with Gloria the other night, and I'm like, we might need to rotate this into something real, like cash flowing real estate. A first world problem for sure, but one that I think I like what you're saying. Don't be the guy that rides it back down. You know what I mean? Kind of pay yourself along the way. As we've been anticipating that this would happen, and we can't be so shell shocked that we don't take action when it does.
Yeah, in that first bull market of the 90s, I was wiped out of my account. The last bull market of the 90s in tech stocks, I was wiped out of my account. Thank goodness I had some restricted stock that couldn't be sold to meet margin calls back then. So I learned some hard lessons. Don't invest in a speculative asset on margin is one of them. That would seem to have been an easy lesson to learn, but it took me a couple of tries. But, I'm talking to you now from my cabin on a bunch of acreage in the woods. This was bought in the last on just taking a ladle, dipping some of those capital gains out of the last bull market. So that's the kind of thing you need to do. You can be all in and be a gold bug and a silver bug and still take profits. You're not violating any kind of sink pact or anything. You can take some money off the table.
Yeah.
So that's like you said, it's a good problem to have, guys. But here's the thing. One of the reasons you're in metals, commodities, mining companies and whatnot, it's because A, you believe in the sector, and B, you know something about it. And that's a good reason to be invested in something. And then now you're looking for something different. Problem becomes much different, right? So Brian, in your specific example, is this the property that you diversified into? Is it something that you'd had your eye on for a long time? It's something that you wanted, that you'd researched long in advance? Or was it a process where you said, okay, I need to diversify out of this and I want something tangible? And did you conduct some kind of economic study? Like, how did you choose that?
Yeah, no economic studies. I'd always wanted my own land and was looking for about 3 years for the perfect piece of property. And it took me 3 years to find it. And I found it at almost exactly the top of the last bull market. If I knew it was coming, I may not have bought it or been that extravagant. But fortunately, I did take the money off. Actually, it worked out well. I did take the money off the table. Not that the bull market didn't hurt me, because again, I was still significantly invested, but I was able to take money off the table and put it into real estate. A really smart person would have put a lot of it into income producing real estate. I put it into recreational real estate and in residential real estate. But I did take it off the table, and that's important. But no real process. There was a decision that the gains were too much to ignore and to leave in the market because I had been burnt before.
Something that Rick likes to talk about, and he usually talks about this in reference to mining companies, obviously, but he says, look, the stock of a company, the price of a company can go up, and at the same time, it can become cheaper, right? Because something has changed. And this relates to something that Steve and I were talking about in an earlier segment, where he was talking about the priced in gold value of residential real estate in the United States. Steve, you want to just recount that for our guests?
Yeah, I can pull up the chart if you want to share a screen right here. I've got the average U.S. priced home in ounces of gold. And I was a guest on another show recently, and that was only a week ago, and it was 94 ounces of gold for one average U.S. home, and now it's at 89.9. So we could see the last bull markets here. This one is 1979, 1980. It was 73 ounces of gold for one home, and then here in 2011 it got to 116. It wasn't that long ago, Brian. You were doing a presentation at your conference saying that it was around 250 or so, and then now we're down at 89, and here it is in silver. And again, last week it was over 6,000, and right now it's 5,280 ounces. So just getting cheaper and cheaper by the minute. And it wasn't even that long ago, October 2022, it got up to 25,000 ounces of silver for one average U.S. home. And now we're probably going to hit 5,000 ounces today or tomorrow. So if you had saved your wealth in silver to purchase a home, from your perspective, homes are only 20% of the cost that they were even 3 years ago.
Just unbelievable. So Steve, we cannot let my wife see this chart, because in the early 2000s, we put a bunch of money into metals, and I told her this was going to happen. And so now that it's happened, she's going to expect her dream home. So we absolutely cannot let her see this.
Okay, deal.
but guys, this is one of the challenges of sort of divesting and reinvesting in something else, is you have to sort of adjust for the corrections, right? Like something that looks expensive is maybe not expensive anymore. And it just looks expensive because you're looking at nominal prices, right? So is that piece of real estate actually expensive? It looks expensive. But if gold gets to 5,000, I mean, what's expensive, guys? Hunter, like, interested in your thoughts about, options outside, or if you think now is the time, actually. Like, are we early on this?
So I've never actually looked at the home price divided by an ounce of gold. I like that. That's going in the chart, and I'm saving it. So, but one thing I do look at is the price, the Dow to gold ratio. It's not a secret. And I also look at the S&P to gold ratio. And if you pull up a chart of the S&P gold ratio, we're in like a 13-year base. And so gold and silver have had this price appreciation, and it hasn't even broken out compared to the stock market. What do you do when you rotate out of metals? That's what I'm wondering as well, because why do you buy metal? For myself, why did I buy metals? It's because of the debasement issue with currency. So do you sell your gold and silver? Gold goes to 10,000 or, some pie in the sky number. Do you sell it for dollars? I don't know. I mean, I don't believe in a perfect market. So I believe that that's how you make money speculating. Speculating is the market telling you you're wrong now just to agree with you a year or so down the road. And I think when the time comes, there will be opportunity. But if I knew what it was, I'd write a book right now and I'd be off on an island somewhere. So, but will there be, the short answer is, will there be something? There will be. What will it be? I don't know. I mean, do we have does the AI, I personally don't think we're in an AI bubble. I think it's too soon. I know there's a lot of comparisons to the early 2000s and, the market right now, and Cisco compared to NVIDIA and so on and so forth. But it just seems like my understanding of the dot-com bubble was that it wasn't a 2-year build up and blow off top like we've had in AI. AI is a relatively new thing. So if we have another 5 to 8 years of this, do the metals in the market top together? And that's the greater depression that everybody's been worried about for the past 20 years, 30, 40, 50 years. I don't know, but It's a good question, Albert, and it's one you need to think about, is what do you do when you're happy with your metals gains? Because you got to go to dollars, unless you're a Bitcoin maximalist, which I'm not. So it's something I'm definitely considering or thinking about.
Yeah, on that, Hunter, before I forget, that because that's a interesting topic, the AI topic. We've got Nomi Prince of Prince Sites joining us in the 4th hour, and I'm definitely going to ask her about that question about AI, because I want to know what she thinks. It's hard to read. I think it's a big problem. I think it's actually bigger than .com, a bigger problem than .com. But 4th hour, if stick around if you're interested in that topic. When Nomi Prince comes, you definitely want to ask her about that. It's really tough because when I think about, we're talking about safeguarding wealth with gold, right? We're not talking about moonshot, trying to get mining stocks are different, but gold. And when you compare gold to any other asset that does that, it's just really hard to make the case to switch. People do all kinds of stuff. When inflation starts going, they get into antiques and exotics and fine art and all that. And Steve and I were talking about planes. People saving their money in planes. People do all that stuff, but there's always like carrying costs, transaction costs, insurance and stuff. It's just really hard to argue. Apart from saying, look, this has had a big run and I'm a little nervous. That's the only argument I can make. If I try to make any other argument, I just can't beat gold as a savings instrument. Guys, comments on that?
Well, just if you don't mind, I'll chime in real quick. As a saving instrument, I would agree with you. First, before I answer that, I would agree with you. I think the AI bubble is going to be a lot worse than the .com bubble. I don't know. I don't have any equations to show you, but that's what I think. Secondly, I agree with you. Gold is the ultimate savings vehicle. What's the old saying that gold is the money of kings and so on and so forth? That's the money of peasants. I was told a story. This wealthy Italian family, I asked him, how did you maintain your wealth for hundreds of years through pillage and sickness and disease? And he said, land, art, and gold. I said, okay, explain that to me. Then he says, you see the raiders coming, you see the smoke. He said, so what do? He said, we put all the gold in a bag, we take the art off the wall, we get on a horse and we ride away. He said, the raiders come to our house. They ransack the house, they burn the house to the ground. He said, but eventually they will go home. He said, and when they go home, I show back up on the horse. I pay someone with a gold coin to build the house. I pay someone with a gold coin to build the furniture. I go back into the house. I dump the gold on the table. I put the art on the wall, and I'm in the same spot I was in before they showed up. And so, like you said, Albert, gold and mining stocks are two different things. One is wealth preservation, and I would say mining stocks is wealth creation, right? So I agree with Brian that you have to rotate, whether it be, real estate or whether it be, physical gold and silver, something like that. I've always looked at physical gold as an insurance hedge. You buy car insurance or house insurance and you hope you don't have to touch it, but it'll sit there. And as long as it's, you're not, at least myself, I'm never looking even on a day like today and counting up how much silver I have and multiplying it by the price. It just sits there and it's there when I need it. So it's definitely a tough, it's a tough pill to swallow when you're such a gold bug. Like, I don't want to sell it, but sometimes that's the right thing to do.
Yeah, I've begun to start looking at gold differently from an insurance policy now. I just look at it as money, because it's marketable for one thing. So you're not just getting it for this catastrophic coverage, right? It's there for you every day if you want to cash it in. But as these fiat money systems, they're like seriously losing credibility here, because the dollar was king of the hill, and it took a beating this year, really did. And I think it's just people are really questioning it now. And so I think it's time to start thinking about it just as money, because that's what it's quickly becoming. I think as we move to a new standard around the world, it's really becoming money. Brian, jump back in here.
Yeah, I agree with you, Albert, but it's not becoming money. It always has been, and I think what we're seeing right now is the world is realizing that it is, and it's the only real form of money. Everything else is a derivative, is currency. And it's Hunter hit it right on the nail on the head. It's insurance but it's insurance against something you know is going to happen, and that's the depreciation of the purchasing power of currencies. That's why it's different from your home insurance or anything else. And so you know it's going to happen. It protects wealth, and I get nervous, and when we see moves like this. But when I think about it, you have to look at Ayn Rand used to say, check your premises. And I think we need to do that occasionally in everything, but in this too, and see why is gold rising. And I think the fundamental factors that the world is coming to realize is that the debt loads that have been created over decades of ever easier monetary policies are too large now to manage without historically low interest rates. Interest rates, in fact, can't be higher than the rate of inflation, or the whole house of cards falls apart now. The currencies have to depreciate in value more quickly than the interest rate you're paying on those currencies. Otherwise, the balloon just keeps expanding and keeps getting bigger. So the world's starting to realize that. And the kinds of moves we're seeing right now in gold are presaging, I think, some sort of a reset. Right now, the world's looking at it as insurance. If we get past, say, the $8,000 range or something, which would exceed the moves in any other bull market from the lows, then I think what we would see at that point is an implication that there's some sort of a real monetary reset in the offing, in approaching. We're not quite there yet, but what we're seeing right now is a broad realization that this is the only port in the gathering storm in global finances, because the debt loads are too great, and it is always a monetary issue. It's not really a geopolitical issue. It's not anything that is a safe haven from war or famine or anything like that. It's always monetary, and it's always what's happening to the purchasing power of currencies. And when people really see that purchasing power is going to be lost at an accelerating rate, then gold has these catch-up periods, and I think that's what we're seeing right now.
I just want to jump in real quick, if you don't
Yep.
mind. But
No.
I agree with you, Brian, but I think there's a geopolitical tailwind as well, and it's a monetary thing, but people were worried about BRICS and their announcement of this gold-backed currency. And one thing someone said to me is these countries don't trust each other. And Rick has that story about his, the guy from Japan who, he was kind of poking fun at him that, you take our IOUs and you give us stuff. And he goes, well, your IOUs are worth a lot more to us than we don't trust anybody around here. So instead of these, a new currency, why wouldn't you just transact in gold if you don't trust the counterparty? And that's kind of where I agree with Brian, is it's monetary always, but there's a geopolitical tailwind where if Russia wants to do business with Europe, you think this will be down the road, but you think they'll ever take euros or dollars again after what they've done? Do you think any country that has any aspirations or any issue, Cambodia and Thailand right now, like, don't you think that this is a worry? And the central banks have put this floor under gold. They don't care what the price is. It's not you and me that are, doing technical analysis. They buy a certain sum every week, every month, whatever it may be, and they're going to keep buying. They don't care. And I think the writing is on the wall that the monetary reset is coming. Does that mean it's going to happen next year? It doesn't. But the average life of a fiat currency is 50 years, and it's been over 50 years since Nixon pulled us off. And I think the market's sniffing that out. I really do.
Yeah, Hunter, I agree with you that geopolitical factors can accelerate the monetary issues and create the monetary issues that drive demand for gold. But I guess what I'm talking about is you see a flare up in the Middle East and the gold price jumps, and that's totally irrational. There's no reason for that. If a geopolitical issue, if war, affects you personally, you're not buying gold and silver. You're buying the other two metals, copper jacketed lead. And that's all you're worried about in the short term. But over the long term, yeah, they can drive that. And I do agree that some kind of a reset is in the offing. Again, we can't, the timing's the part where you'll really look stupid if you try to predict the timing, and nobody can predict that. But Hunter, you alluded to something else that I think that's an important point that I've been making over and over during this bull market, is that the central banks have been, first, they drove the price up because they're buying, again, not as investors, not subject to the whims and emotions and the ebb and flow of emotions, but strategically. And it really seems to me that it is literally dollar cost averaging. So they are buying a certain amount, dedicating a certain amount of gold for whatever time period, weekly, monthly, quarterly, or whatever, and they're just going in the market and they're buying gold and they're upping their reserves on a percentage basis. Naturally, as the price goes up, that means the tonnage drops. They're buying less. So I think the central bank buying has reverted to a support to the market rather than the driver. And I think the Western investors are coming in and really driving the price at the margins right now. And that's why we're going to have more wiggles in the line going forward, more of the, probably not the kind of volatility we've been used to in past bull markets, but more volatility than we've seen in this bull market.
There's a question here from Dr. Jose. Brian, maybe you can comment on this. And I'll throw it in for gold as well. He says, given the rise in physical silver spot price, should silver miners rise correspondingly once they report their earnings?
They should. We have not seen miners in general react to or provide the kind of leverage. They have not been able to keep up to these kinds of moves. I think they will happen. Silver naturally leverages gold. That's why I've been beating the drums on silver for months now, saying it's going to play catch up. And silver miners leverage silver, so you can layer leverage on top of leverage by buying the silver miners. And I think there's still time. They are having some moves today. Some are up 5-7%, but they are still underpriced relative to what the silver price has done. I think they will eventually. Again, the timing. I think the quarterlies, the financials. Yeah, I think that could be a big catalyst, and it helps. But, getting back to what you had mentioned, what Rick had said, how, sometimes things get cheaper as the price goes up. Another way to look at that is the miners right now have gotten cheaper as the price goes up on a price to earnings basis. You look at the big miners, look at Agnico. It's still, bouncing around some of its lowest P to E ratios than as it's ever had, even though it's making money hand over fist. The margins in the miners right now are far above where the gold price was a year ago. And that's, they can really screw up really badly and still make a ton of money. There's a lot of room for error here. And that has not been reflected in the share prices yet.
Okay.
Steve,
yeah.
Thanks for picking that question. I think it's a great question. So, and it reminds me of something else. It's like, the inverted yield curve, guys. When you talk about spot silver versus the price of silver miners, you're talking about present silver versus future silver. Just like in a yield curve, you'd be talking about Fed funds at 0 time versus the 10-year or whatever. And when the curve inverts, basically the Fed is doing something to the short-term interest rate that's not being reflected in the long, like the market doesn't believe it's going to sustain. So it's like you get a rise in the silver price that the market doesn't believe is going to sustain long enough to really be worthy of a repricing of silver assets. And I'm wondering, Brian, I wanted to ask this to Adrian. Unfortunately, he's gone, but to you as well. What does it take for a new price to get priced in to the arithmetic of, a big producer or into a economic feasibility study for a junior? what does it take for them? Because I always hear them doing these prices and say, oh, for gold we're using, and it's some low price, right? What does it take for that to finally get rolled in to the study? Like, when do they actually believe it? When will the market accept $4,500 gold?
It's time. It's time. It took 3-4 months for the market, as I mentioned, over the summer to accept $3,000 gold, and that was really because the gold price refused to fall too far below it. And if the price refuses to fall, then you accept that that's a new floor, and then you can reprice according to that floor. So it's just getting used to it. What we're seeing now, the market cannot get used to it, and it is a bit of disbelief behind.
Yeah, so that's actually the question, right? Like, what does it take? What do you think it takes? Is it just time, where it just persists for what is it exactly? Are they looking at the macro? What are they looking at?
I think it's time. I mean, they're looking for that explanation. And if you look at the mainstream media, financial media, news shows, they are just grasping at air, trying to figure out why gold is going up, why is silver going up, and they're calling it a speculative bubble, and they have really no understanding of.
You can't trust them though, right? They're just trying to put doubt in our mind. They're not on our side.
No, they're not, but they've had some people on there that have told them, and then it's just like their eyes glaze over. Ray Dalio's been on there. Paul Tudor Jones has been on preaching this for well over a year, 2 years, and they've got a lot of respect for those guys. When Jim Grant talks, they all hush and listen appropriately. But do they really hear what he's saying?
I don't think that, those people, okay, they're extremely polite, and they tend to talk in language that's maybe above the comprehension of the people watching, so they don't really understand what they're being told. But when Peter Schiff goes on there, he says it in plain English and just punches them in the face, and they hate that. They absolutely hate that, and he gets banned.
Yeah, Peter doesn't pull too many punches, and it's kind of like shouting into a wind to try to talk back to him. But Peter's been right and absolutely right. I find very little that I ever disagreed with Peter on, at least in the financial markets. But yeah, he's been right, but he's pretty bombastic in saying he's right. And, I don't think that helps him.
No, but for good reason. Brian, sorry, can I interrupt you for a second? Because I think we have coming in from the shopping mall, our friend, George Gammon, Rebel
Oh,
Capitalist.
my goodness.
George, what is up? How are you? Do we have
I hope
George?
Brian wasn't just talking about Peter Schiff.
Yes, I was. One of my favorite topics. And yours, George.
George, the last
about
time I
that
saw
dollar,
you, I
huh?
think you were shopping. What's going on? What are you buying this time?
Oh, that's right. Yeah, because it's at New Orleans. Well, this time I'm doing some family shopping for people who actually can wear the small
you don't
sizes.
sell
they have
families
in
at the
Medellin.
mall.
Yeah. No, I'm not shopping for a family.
Okay.
Literally. But yeah, silver. Congratulations to, I'm sure most of you guys own quite a bit of silver. And I wish I owned some. I had the miners and I had a bunch of gold. But man, I could not believe, I did a quick video today and I saw that silver was up, 150% on the year? I mean, just unbelievable.
We're not drunk. We're just really happy.
It's going to, yeah, you should be. It's great. I guess, it poses an interesting question, right? And it's not just for silver, but it's for investing in general. It's like, when do you sell? When do you hold? When do you add to the position? That's almost as difficult as knowing what to buy. In fact, the video that I did today, I went back and referenced Marty Zwag's trading rules from 1990. I don't know if you guys know who Marty Zwag is, right?
Yeah.
No, I don't. Sorry.
You guys hear me?
Yeah. I
go
know.
ahead. Tell us the
Marty used to speak at our conference way back when. Yeah, I don't know if George.
Oh, you
can
guys
hear.
don't know who Marty is?
I do.
Yeah. It's cutting out.
I think maybe this is
Strange we're getting the video but not the audio.
While we wait for George, Brian, why don't you tell us about Marty at the conference?
Well, he's got great rules for trading and the like. And one of the things that George was hitting on, do you hold? Do you buy more? Do you sell? I think the question you need to ask yourself is, why did I buy it to begin with? And this goes back to what Hunter was saying. You look at it as insurance. And if you look at it as insurance, the reason for that insurance has not gone away. In fact, it's probably going, the embers are starting to heat up, and gold is telling us that something bigger worth insuring against is coming up down the road. So if you bought it for insurance, you probably need to hold it as insurance. But if you have to also recognize the trend, recognize the move, what's driving it, and you can build wealth again, as Hunter put it so well. It's for building wealth in the miners. The miners are where you leverage these moves and build wealth by exploiting one of these big catch-up periods like what we're in.
That sounds a lot like Rick too. And it kind of points out one of the differences between gold and mining stocks, because if you get a big repricing in a stock, it could be because the thing that you bought it for has now happened, in which case it's time to sell, unless you find another reason to own the stock. But if gold provides insurance as it's designed to do, it's just more reason to hold it, isn't it? Because it's just indicating that it's doing what you bought it to do.
Yeah, absolutely. It is insurance. Silver leverages it. Now, all of that said, I've made some or aggravated some people when I've said that in the ultimate reset, whatever that is, I think at some point they're going to reattach the currencies, and not just the dollar, but fiat currencies. All the important fiat currencies will have to reestablish their credibility. And the way to do that instantly is to reattach them to gold. I don't know at that point, because it will be central banks doing that reattaching. I don't know if they're going to bring silver along. But in the meantime, buy silver, because should be a good ways away from that kind of a reset, and you're going to enjoy periods like we're having right now. The deepest analysis I can make on why buy silver, or why is silver going to leverage gold going forward, is because it always has in the past, and therefore it should continue perhaps until that reset, but perhaps only until that reset, but it's going to keep doing that.
Regarding the reset, I think that's like a little overly dramatic. I want to get your thoughts on this, guys, because what we're seeing, like, it's not a button that someone's going to push, right? And then all of a sudden we're going to be on some metal standard. It seems to be happening gradually, just over time, starting with bilateral trade agreements among BRICS and BRICS Plus, where they're not launching a new currency, but they're also not using the US dollar. Like, that's half a step. Anyone?
Yeah, I don't think the dollar is going to lose its dominance, lose its status as a global reserve currency in any time frame that matters to us right now. It's more than the aircraft carriers. It's more than BRICS or anything else. It's just the rule of law. Money goes where it's treated best, and it's still treated best in the U.S. A lot of room for improvement, of course, but it's still treated best in the U.S. than it is in other countries.
Hey, George is back, and he just sent me Marty's investing rules.
Oh, cool.
Hey, George, welcome back.
Hey guys, sorry about that. The reception's really poor here. I don't know if you guys can hear me, but I just sent you the Marty Zweig rules that I was referencing. And, I've done extremely well in my portfolio this year. And I would attribute a lot of that success to just following these rules because, when something's really running right now, like silver, it's very difficult to know, like, should I buy, should I hold, should I add to my position? And if you just follow these rules and kind of refer back to them, it kind of takes the emotional decision making out of the equation and helps you just make better decisions based on, what's worked, not only just going back to Marty's days, but going back to Jesse Livermore. These rules that you can see right here, it's not just applicable to the 1990s, it's applicable to every single decade of investing because it's based on human nature.
Yeah, very interesting.
As far as the, can you guys hear me?
Yeah, we can hear you, George.
Okay, as far as the dollar, I heard you guys talking about that. One thing I'd encourage you guys thinking about is commercial banks, because you have to put yourself in the position of a, let's say, Eurodollar commercial bank where, let's say, 90% of your liabilities are dollar denominated. So if 90% of your liabilities are dollar denominated, you cannot buy any other assets other than dollar denominated assets. It's not, there's no way. No one that runs a bank would ever do that because you're taking FX risk, right? So what happens is if you, let's say you have all these dollar liabilities and you buy gold, well, it's great if it goes up, but if it goes down and you get some redemptions or you have to make some transfers to other banks, then you're screwed. So there's no bank that's going to go ahead and take that type of risk. So they've got two options. They're either going to lend into the real economy, but that's going to be a dollar-based loan, or they're going to buy treasuries. That's it. That's it. So this is why among the network, that's why the dollar maintains its dominance, let's say. It's not because the central banks are doing deals with BRICS, or it's just the cleanest dirty shirt, or it has nothing to do with that. It's really just all about the dominance of the dollar due to the network effect. So if I'm using dollars, it's very similar to the English language, right? Like, let's say that you guys discovered a language that was just way better than English. Like how hard would that be for you guys to just switch over really quick? You see, and you say, well, George, the currency you can switch over very easy, but you really can't, because if you understand what a currency is, it's simply a network of bank balance sheets. It's a network of, unfortunately, derivatives. It's a network of features. It's very similar to an iPhone. How the iPhone has, one of the things that makes the iPhone special is it has all of these apps, right? So no one would use a Motorola Razr anymore. Why? Because it doesn't have any apps. It doesn't have the functionality. But the dollar network has all of the apps. It has all of the functionality that we as retail investors don't even think about, such as interest rate swaps. Like if you're a huge corporation, multinational, you have to have access to things like interest rate swaps. And you can't do that in gold. You can't do that. You might be able to do that in euro yen, but it's far easier in dollars. So, and then you can take more risk with your balance sheet, and you can make more profit if you have these apps, let's say, that allow you to do financial business in a way that's far smoother with far more liquidity. So it's a combination of both those things, which is why the dollar remains dominant. And if you look through it strictly through the lens of the central banks, or cross-border transactions between India and China that are settled in whatever yuan, you kind of miss the forest through the trees. And in the sense that you're focusing on what the governments are doing, and that's all fine and dandy, but at the end of the day, that doesn't matter. It doesn't matter what FX reserves the PBOC has. What matters is what real entities are doing in the real economy. That means the banking system, and that means corporations. And that means small and mid-sized businesses in China. That means small and mid-sized businesses in Saudi Arabia. That means banks in Saudi Arabia. And when you get down to brass tacks, you see that they're all using the dollar. It doesn't matter if they have some sort of deal between the governments. They could care less. Why? Because that dollar network, those features, those apps have served them very well. And they've literally built their business around that network and around those features. So to ask them to change, it would, again, it'd be similar to us trying to do business in a language other than English. It's just nobody's going to do that just because it's too cumbersome. And there would have to be a form of money that was not just better than the dollar. It would have to be like 1,000 times better. It'd have to be like 1,000,000 times better. And it's not out there. So, one of the things that I talked about in Brian's conference at the evening seminar is when I went across Argentina, you find out very, very quickly what gives money value. And most people get hyper focused on the store of value. That's not what's most important. That might be important to a gold bug, but I can assure you it's not important to someone in Argentina. It's not important to someone in the real economy. Why? Because what matters most is the network effect, the usability of the currency, because everyone else is using it. So you have to look at the any type of currency in the form of what actually gives it value. And it is true, the store of value is a component, but a store of value is like way down the list of what really gives the utility, I think is the right word to use for the currency. It's all about utility. And that's why when I went across Argentina, people didn't want gold. They didn't want silver. They didn't want Bitcoin. And most of them, the people in the cambios and whatnot, they obviously wanted dollars. But if you went into a cafe in Argentina to pay with dollars, they'd just tell you to F off. They'd say, what are you doing? No, we want pesos. Everyone takes pesos. Why? Because of the utility. Why? Because of the network effect. So, my point here is you have to consider those things when you're doing your analysis, because at the end of the day, those are the things that really matter. It's not just if India is settling a big oil shipment from China in yuan or something like that. At the end of the day, that's not really relevant.
George, good to have you back. Thank you for joining us in the middle of your day. Appreciate it, guys. We got to move on to the next segment.
Oh yeah, sorry about that. Sorry for getting long-winded
there. George, he's a rebel capitalist. I'm sure everyone knows him. Brian London from the New Orleans Investment Conference, and Hunter Mocheri with the Independent Speculator. Guys, it was great working with you all of this year. And thanks for taking part of your holiday to say hi to our followers. And really looking forward to next year, guys.
Same here.
Yeah.
All right.
Thanks for inviting me, guys.
Appreciate
it. Holidays,
Thanks
Merry Christmas, and a Happy New Year.
Same to you guys. Bye.
All right. That was great, Steve.
Yes.
And the show goes on. I want to share a comment someone had, made me smile. Where did it go? It's moved up a little bit at this point. Oh, I'll try and find it. We outlasted someone's wireless headset.
Yeah. You didn't bring enough headphone juice. Yeah, Berkowitz.
I love it. That was my goal. But we're not stopping. We're not stopping. I want to see at least 5 more of these comments.
Yeah.
Okay. So this is a special segment we got coming up because every month at Rule Classroom Plus, we have a number of expert lectures from people like Joel Lippman, Adrian Day, and Joe Mazumdar, who is with us today, who is going to be doing his lecture for us right now, actually. So if you're not part of Rule Classroom Plus, please stick around. Consider this a sample. Joe does this for us every month. It's great. People pay a lot of money to be part of his newsletter, Exploration Insights, and he shares a lot of that great insight with us here on a monthly basis. So Joe, Hope you had a Merry Christmas. Thanks for being here on Boxing Day. How's it going?
Good. I heard something about Argentina from the last commentator. I'm actually there now. So
nice. Business or pleasure?
There is no pleasure. I come here like I used to live down here back in the 90s, and my wife's from here, so we've been coming back every 2 years since we moved in 2000.
Joe pretends to be the hardest working guy on the team, and
Pretends?
I have to say you do a good job pretending that, because it seems very convincing. You're always traveling, you're always writing reports. It's a good act.
Isn't it? That's why, like you were saying, like the people pay so much for the letter. It's economic, very economic.
Including Rick Rule. Look, you're well, it's coveted analysis. I'm not joking. It's Rick talks about it, and we always enjoy your monthly installments here at Rule Classroom Plus. So thank you for that. Let's get on with it. What are you going to talk about today?
Well, we're just going to do a review of the year, and mostly, basically a lot of sectors have gone up. If you hear screaming in the background, it's because I've got 5 kids outside, and I've shut the windows and everything like that. It's 35 degrees Celsius, so I am suffering, just so you know. And the main floor of the place we rented does not have air conditioning, which is ridiculous. But anyway, I'm here for you guys.
Thank you, Joe.
I was talking to my mom in Calgary, and they had minus 25 the day before yesterday. So,
oh wow,
yeah, it could be worse.
That's a big spread.
Yeah, I mean,
negative 25 to plus 30.
Well, I mean, worse for me. I mean, it wasn't minus 25 is fine. I mean, it's plus 35 that's the issue without air conditioning. Anyway, so what I was going to talk about is just go through the year, but I was going to focus in on what probably people are interested in: precious metals. We'll go into gold and silver, talk about some of the thematics behind it and the impacts. And then we'll go into something else that I'm quite a fan of, is base metals and copper. We'll talk a bit about that. And as the comments come and the queries, that'll probably take up the rest of our time. So I will probably, if the comment is directly related to the slide I put up, I'll answer it right away. But if it's something else, we'll take it after.
Okay, you want to present your slide then?
Yep, I will do that now. Let's see.
Just a sanity check. You can see the comments, right, Joe? Or do we need to read them?
Yeah, I got the comments on the side. Okay. But if you guys, while I'm talking, I have to flip between screens. So I might miss some. Let's see. There we go. Can you guys see that?
Yep, it's coming up. Give me 1 second.
Okay.
Give me 1 second. I'll get it up. Interesting. Oh, here we go.
All right. Okay, that's big enough, because if we put on the display or something like that, it sort of cuts out and I can't move it. So that should be fine, right? Is that all
That's
right?
okay.
Okay. All right, let's start. So as I said, we'll go through the precious metal sector, the drivers, what we've seen so far, and we've obviously got record highs just recently. But silver is beating gold. The impacts on the market in terms of sentiment, in terms of what people are doing, companies. Industrial metal sector, that's a focus on market imbalances. We'll focus in on PGs and copper. And then the record high, as I measure it with the XBM on the TSX as a base metal equity ETF, has also hit record highs. So let's go forward. Okay, so this is what I do every week. To sum up what happened during that week, we do a bunch of commodities as well as equity ETFs, indices and that, the US dollar, things like that, tips rates. And we look at how that's changed week to week. So this is a year-to-date 2025 to the end of last week. And so what we're going to be focusing on is to the right, In terms of commodities, the ones that have done the best: silver, platinum, and palladium, and then gold. And then you got to go a ways before you get to copper, which is about 35%. But the important thing here is for us that invest in equities and physical gold, I do both, is that the equities are providing the leverage. So gold is providing the leverage, gold equities to gold, because gold actually has underperformed silver. So when you take the precious metals equities, the GDXJ, using that as a proxy, which is what I benchmark our returns to, it's done better against gold than it has against silver. Silver, again, is up 130% year to date. Let's go. So I thought I would intermingle this with pictures from the site visits we do. As Albert points out, we do a lot of site visits. We get out quite a bit. And this was one of my last trips of the year, and that was -20 north of the Arctic Circle, north of Rovaniemi, a place called Sodanka in northern Finland, not far from the Russian border, but excellent northern lights. This is a picture of some coarse gold. I don't call it visible gold anymore because that's sort of redundant. But what I got this new camera, just so you know, and in case that wants to entice you into subscribing to the letter, is that little white dot of the circle there on the left. I could blow that up now and I could see the coarse gold in it. Like before, it was much more difficult to do. Now I can do it. But anyway, that's a project up in northern Finland. So that is gold. And so you can see this graphic of year-to-date gold price, the yellow line, and then a 20-day moving average. And basically, when the 20-day moving average, when the gold price pushes up over the 20-day moving average, that's what's known as a golden cross, and it's lifting the average up, whereas a death cross would be if it falls below it. So we've only seen maybe a couple of death crosses, and they didn't last very long. But we had 3 significant periods, and we're living through one right now of where the gold price shot up. Near the middle of near the beginning of the year to mid-April, it went up 30%, flatlined for a while, as probably a lot of people were wondering what was happening with the interest rates. And central bank buying was still there, but it wasn't as high as it was before. And then we had a big jump when anticipating the next rate cut. But then we flatline because most of the discussion there was about higher inflation, not meeting the target inflation of 2%, the impact of tariffs potentially. But then everyone started thinking that, well, the U.S. Federal Reserve Chairman is not going to be around, the beginning of, I think it's like May or something like that, when he's going to be replaced. And the candidates that are looking to replace him are all talking about more rate cuts. And so that's probably one of the factors that's driving gold price right now, as well as some of the geopolitical crisis, whether it's a Armada barricade in Venezuela to what we've just heard now, what's happening in Nigeria. All that is, it supports the gold price, but usually geopolitical crises have an ephemeral, they don't resonate very well, very long, on the gold price impact. But we've gone through a lot of crises, and so we just bounce. And so we've always got this support from geopolitical crisis for the gold price. That drives some of this haven demand, ETFs as well. So that's all positive for gold. So we can see this graphic that I might have shown, just a repeater here. So this is quarterly data from the first quarter of 2010. And you can see I average the total demand by central banks over that period to about COVID, to the COVID-19 pandemic, where central bank demand, most of it was positive, was 10 to 11% of total demand. But since COVID, post-COVID, when also the Russia-Ukraine war, when banks started seizing Russian assets, that was a big impetus to diversify away from gold and to push to hold more gold in reserves. And so since that period up to the first half or the third quarter of this year, central bank demand has been about 24 to 25% of total demand. So more than a double of what it was before. But interestingly, it peaked right around probably the Russia-Ukraine crisis at around 37% of total demand. So that's one big factor that's underpinning gold. But what I would say right now, it's probably supporting gold when interest rates and that kind of demand doesn't exist. Gold doesn't drop as much as it used to. And so the graphic you see here is for 2025 year to date, up to October from the World Gold Council. So you see different layers. The first layer would be North American demand for gold through ETFs, exchange tradable funds. The next level is Europe, the light blue, and the dark green is Asia. And then there's other, which is a thin skim over everything. But what I've done here, the colors there are showing you the year-on-year growth that month, January growth in equity ETF, gold ETF demand versus the same month last year. So you could see that the biggest demand, even though overall it's not, the biggest demand, the biggest growth in demand has been Asia. So that started in January and was double what it was January last year. In October, it was, it was almost, 160%. So 2.6 times what it was last year in October. But also you can see for North America, which is the largest consumer, there it has actually exceeded the average since I would say since April. So it's been driving the average higher. So average was 65% in April. North America was up 66%. In October, average was up 76%. North America was up 81%. Europe is below the total average in terms of growth year on year. Everything is positive. Everybody's buying. I'm just pointing out who's buying more and who's driving the average up. That is definitely Asia, and the last several months, or more than half a year, North America, which is basically the U.S. So this is a picture of a project I visited, and we own in the portfolio called the project's called Diablillos, Little Devils. It's in northwest Argentina, a province called Salta, at about 4,500 meters. A lot of lithium projects around there. This project's been around for a while. I visited it. Well, I used to drive by it, let's say, back in the 90s when I lived up in Salta. And you could see the different targets there. This is a long section over a couple of kilometers from their target called Oculto, which is the gold-rich target that they're drilling right now. They've got a pre-feasibility study. They're going to go to a feasibility study next year. But in Argentina, there's this new program called RIGI, R-I-G-I, about incentives for projects that are over 200 million US. This one is just applying for that. That gives you a lot of tax incentives as well as lowers the duties on exportation. And the whole regime makes it easier for companies like this, which is Abra Silver, to actually borrow money from overseas banks, which was not possible before because there was basically you couldn't repatriate funds very easily. For silver, the most important one is the Jack target, which is to the left. It's lower tonnage, but it's very high grade, and it's a zone of silver enrichment in the volcanics. That's what they would be mining first. So that's a little diagram of what a silver deposit actually looks like. And now here's the silver graph. The red line is silver price from 2005 from Kitco, and you can see how it's gone, basically hyperbolic in 2025. Up to the middle of April, and the little inset is actually the gold to silver ratio, which peaked in the middle of April. So it got up to over 105. So the gold price was up 28% up to that point was at about $3,400 and $3,425 per ounce. Gold had only gone up, silver had only gone up by 9%. So it was only at 32. But since that time, the gold to silver ratio has, compressed significantly. So it's gone from 105 to 63 as gold price went up another 32%, but the silver price went up 120%. So what's driving that? We can see that this is the market balance for the silver market. So where it's positive, it's dark blue in millions of ounces. The circles, the open circles, are including the demand from exchange tradable products. So silver ETFs, ETPs. So you can see the gray line is actually the average annual silver price that I calculated. So you can see that the silver price was, $15, something like that, in the late 2010s up to 2020, and then it started going over $20. And then after 2024, it's, that's where we've seen it really go. And what's driving it, as well as, the gains from gold and being, riding on the coattails of gold, let's say. But riding on the coattails of gold, you probably, you drive that the deficits, because all that red is 5 years in a row of deficits in the silver market. You can have a deficit if you have a large global inventory of a metal. The deficits, it takes a while for the deficits to have an impact. Now that we've had 5 years of cumulative deficits on silver, and combine that with what's happening in the gold market and the precious metal market, and people may be looking for silver not only for clean technologies, but also for precious metals in terms of silver being cheaper than gold. But that's probably putting a strain on the market as well, and that's probably having some of the rationale by the latter part of the year that that we had such compression in the gold silver market. So now let's look at the improving sentiment, and that's where we live on the equity side. So this is a typical metals investment forum that happens, I think 4 times a year or 3 times a year. I go in January and PDAC in March, in September as well. But this is just to show you that the one coming up in January is fully packed. They can't get any more companies on. And the companies are actually obviously paying to get in, but they can't take any more companies. And the same thing happened at the Boca conference. There was such a difference in the Boca conference between this last summer and the summer before. I mean, one of the rooms, they had a lot more people doing interviews, and a lot of that area was taken by companies this year. There was a lot more activity, and that's not just at Boca Precious Metal Summit, same thing. And I can show you here in the next graphic. You can see the improvement. So on the left-hand side is the growth in registered attendees at the Precious Metal Summit in Colorado, probably the benchmark for precious metals conferences globally. And then the number of companies. So you've gone from 160 companies in 2024 and about 8,000 meetings to 220 companies and, well over 9,000 meetings. So, much more activity. And on the right, there's more data there. That's every conference that the Metals Investment Forum did, from September 2019. And I've labeled these, like the bars that are blue are the ones that were in person. So to try and get that effect out of the way, and virtual is gray. And then the number of companies are the squares. So you can see that the September conference last year that I attended had some of the highest number of companies, almost 40, but also had between in-person and virtual, had, the highest number of attendees since January during COVID, like about 2021. So very impressive. in terms of people taking an interest in our sector. And so what do we see in that sector? The rise in the gold price in terms of all-in sustaining cost margins. This is a graphic done by Ron Stewart of Red Cloud Securities, one of my colleagues. So you can see here with the big companies, the economies of scale have driven their all-in sustaining cost margins. So their all-in sustaining costs on the left is that dollars per ounce. So you want to be low on that side, and you want to be to the right in terms of production. So the red ones are the senior producers, the blue ones are intermediate producers, and the green ones are the junior producers. So the junior producers and the intermediates are all over the place, but you can definitely see a trend for the seniors in terms of economies of scale and driving their costs down. I mean, this is interesting for me in that Agnico Eagle is one of the best performing stocks. Offers dividends, cash flow, low geopolitical risk jurisdiction predominantly, and gets a premium. But also, one of the reasons is they're the lowest all-in sustaining costs. So even though the gold price has gone up, and these companies are offering better shareholder returns, like Newmont is, and Newmont is almost by itself with respect to production. Newmont, post mergers, is talking about cutting. They're still talking about cost cutting, especially G&A with the beginning of a new CEO. And there might be more M&A to come with them if we have the Barrick split. So this is an important graphic with respect to what people are doing with free cash flow. I might have shown this before back in September, but I've updated it for Q3. But basically the entire bar, I did this in September for the people in Rick Rule Classroom. The entire bar is free cash flow. And what I've done is eaten away at that bar by saying how much of that is dividends and how much of that is share buyback. So those are my two proxies for shareholder returns. And so the percentage is taking that total, share buybacks and dividends, and dividing it by the entire free cash flow. And you can see the best return is Lundin Gold, which continues to hit record highs. But predominantly what it's doing, 80%, it gives back to its shareholders, but that entire bit is dividends. It doesn't do buybacks. It just pays off dividends, which its shareholders love. The other one is Pan American. Pan American has always had a history of paying good dividends and providing shareholder returns, and they've done it on, obviously less free cash flow, but they're paying a lot of it back. The other one is Fresnillo, and because it's Mexican-based, to attract new investors, they have to offer a good dividend, and they do. They don't, share buybacks is not what people want for them. They want dividends. Newmont, because it's US based, a lot of low geopolitical risk stuff, assets, they can offer more in share buybacks. So the dividends don't take up as much. And so they give about half back to the shareholders, which among their seniors, it ranks, highly, as well as Anglo Gold Ashanti, which is also at 50%. Barrick went up in Q3 to 46%, but you can see Agnico is a bit of a laggard at 27%. And Kinross. You get down to Alamos and some other companies that are more, once you get to the intermediates who can show material growth because they have lower production profiles, they tend to put more of their money into development capital and growing their asset base. Okay, and so if we look at the equities, so this is the GDXJ, what I said we use as a benchmark for precious metals equities. You can see that since its inception in November 2009, starting at 100, it peaked at about 176, and that was around 2011, the tail end of the commodity super cycle. And most of the time it's been trading below its inception. But lately, it's gone up to about 120, and that was last hit, back in 2012, around April 2012 or February 2012. Sorry. So everything seems to be showing a return to these peaks. And so now we look at enterprise value per ounce. So enterprise value per ounce, enterprise value is calculated. You take the market cap of a company, you look at their balance sheet, you subtract working capital, which is basically net assets, current assets minus current liabilities, and then you add debt. So you do that and you divide that by ounces. So you could do ounces different way. You could do only reserves. You can do only measured and indicated, or you can do what we call total mineral inventory, which would be measured, indicated, and inferred. So this is all the ounces they have in their tables. So the top line is producers. And, same sort of coloration, I guess, in terms of intermediates. So you can see seniors are red. Intermediate is the one that's getting the highest dollar per ounce, and that again is Lundin Gold. One reason is they have a high margin. The other reason is they pay dividends, which more than offsets the fact that they are a single asset producer in a highly risky geopolitical risk jurisdiction of Ecuador. The other one, which got bought out, was New Gold. Predominantly North American assets, Canada. They don't have as low a margin as Lundin, but geopolitical riskiness is very low. They also per ounce were very good. But the average, that's why we always like to show the spectrum. The average really doesn't define the line very well, And then if you look at, most of our interest is probably in the exploration companies, the developers, the non-producers. You can see quite a gap, between 332 ounces, 30 or 370 per average. But let me take a step back here. Just looking at the graphic, you can see the asymmetry between the average being higher than the median. So the median is the actual middle of the data, what we call the P50. So 50% of the data is above it, 50% is below it. The average is higher. Why? Because it's being skewed by the New Golds and the Lundins of the world, dragging these to the right. So those, 5 companies on the edge, 5 or 6 companies on the edge, they're dragging this curve to the right and more than offsetting those 6 companies on the left. If we go to the bottom graph, again, exploration, development, non-cash flowing producers. The orange guys would be exploration companies. Silver explorers is blue. You can see how well they've done. One of the ones that has the highest gold equivalent ounces is Highland Silver, which is in Peru. I visited that project last year. Its issues, it's very high grade, but it's low tonnage. And so that's why, in terms of valuation, people get excited by the high grade, but, it's not a lot of ounces that they've delineated yet. But again, you see the big delta, and here's is almost a bigger delta with the right-hand side of the curve dragging up the actual average. So the average is about $140 an ounce, whereas the median is like almost 80. So a big difference between the median and the average as these companies to the right, which are the silver guys, are dragging this thing to the right. Okay. But also I want to point out that, we talk a lot about the orphan period, about developers and stuff like that. But what I've seen is because of the potential for M&A, and there's so few projects out there that are that advanced, developers are getting more, developers that have good management teams, good assets, get access to capital, decent jurisdictions. They seem to be getting, they're definitely catching a bid. Okay, and so in this environment of higher gold prices, positive sentiment, what majors are doing is all the assets that are non-core, they've been divesting. And so that's been happening for Newmont back in 2024. They had a big divestiture plan, about $4.5 billion. But one of them was no bid, and that was the Coffee open pit heap leach project in the Yukon. They couldn't sell that one. They couldn't give it away. I mean, they probably still gave it away. They sold it for about $150 million. And I think, I can't remember what Goldcorp originally paid for it, but I think it was easily double that. And you can see, it finally got bought out. And what we're seeing these buyouts being by companies, because the sentiment is so much better. Management teams are raising capital themselves, putting it in a shell to buy this asset. And so there's a new company out that bought Coffee. And so this is a bit of the M&A. So as you can see, sorry for the delay, but I'm toggling back and forth to make sure the slide advanced. But you can see here's the companies. So on the left-hand side, early November 2025, that was the Coffee project that Newmont had. So they are the seller. And that was acquired by a junior developer. I forget what the company's called, but it's some of the guys that were involved with the Pan project, I believe. And more, recently Probe as well, the end of October, New Gold being bought. So the left-hand bar, the dark blue bar, is how much was paid for the asset per ounce of reserves. Not all of them have reserves, most of the ones to the left. And then how much was paid for total mineral inventory. And you could see some of the best valuations came from those single asset silver producers, mostly in Mexico, that got bought out more than a year ago. So at that time, they looked very expensive, but given what silver price has done, they don't look expensive at all right now. So you can see the purchases: Silvercrest, Gato, New Gold is a big intermediate purchase. Sentiment, single asset producer, but hundreds of thousands of ounces. I visited that project called Sukari, a big open pit in Egypt. Adriatic, not so much of a precious metal, more probably polymetallic, but Dundee had attempted to buy some other assets that they couldn't get. They have synergies being in that part of Europe, and so it makes sense for them to take Adriatic. Barrick sold their last operating asset in Ontario in Canada called Hemlo. That again was taken by a management team, I think led by Bob Quartermain, ex-Pretium, that's now got a company called, I believe, Hemlo Mining, that's taken that over. And then you have Mag Silver, another silver producer, but they are not the operators. So they were purchased, I believe, by Pan American, but they have 44% of Juanicipio. Fresnillo is the operator, which this is interesting because Fresnillo, they didn't buy an asset in Mexico. They didn't buy Silvercrest, they didn't buy Gato, and they didn't buy Mag Silver, which would have made the most sense because they are the operators of that asset. What they did buy was a little Probe Metals project in Ontario, which might speak to a signal to the Mexican government to get themselves sorted out. And then they'll start investing more in Mexico. I don't know, but it stood out to me to be of interest because the companies that were acquiring the silver assets, operating assets in Mexico, were TSX listed companies that were already in Mexico. First Majestic, Hecla, those sort of companies, silver companies. And speaking of M&A, this is one of the assets I visited a couple of years ago. This was one of the big returns we got this year was Origin Royalties, which held a 1% net smelter return royalty on this Silicon Merlin project. I visited it during the Nevada Gold Symposium. I believe that was in 2022 or 2023. And they only knew about Silicon, and that was $4 million. It was a blind discovery underneath a silicified chalcedonic blanket. They had a model and they drilled it, which was Anglo Gold, and they hit it. They hit Silicon. As they did more geophysics and found out a new geophysical technique worked, they found Merlin. And Merlin is about, I believe it might be 14 or 15 million ounces. So that was even bigger. And so Origin's share price went up significantly because suddenly they had a royalty on a world-class tier 1 asset in Nevada being operated by the company that's going to build it, AngloGold Ashanti. This discovery, the people that were involved in the discovery are the winners of the Thayer Lindsay Award in PDAC coming up in 2026. So this is what I call the de-Randgoldification of Barrick. So Barrick merged with Randgold back in 2018, September. They inherited all these big assets in West Africa, Mali, which has had obviously a military coup, another one. And they suspended operations at one point. But since the departure of Mark Bristow that had, I guess, his own terms as how he wanted to end that, they basically made an agreement really quickly after his departure. But the whole idea of making these agreements and cleaning up the structure, putting out, the scoping study on 4 Mile, which is a huge asset for them, and some people have that being 35% of Barrick's value is just that one project, which is in Nevada underground. So the idea is to split this company between the highly geopolitical risky assets, which includes Reko Diq in Pakistan, everything in Africa, into one company that might be carved out for the Chinese, like Zijin Mining or another state-owned agency there, enterprise there, or Middle Eastern groups like Ma'aden or something like that. Although Ma'aden tends to be more interested in critical minerals right now. The signal here was an activist investor, Elliott Asset Management, that disclosed a $700 million stake in Barrick. And now they might be the ones that are pushing them to do this split. And that split on the low-risk geopolitical risk assets might be Newmont, because Newmont would make the most sense because the most profitable part of it is that the ownership of the Nevada gold mines. So, and this trickles down. So we have the gold price going up. We have more people attending conferences. We got M&A, and we see what's happening with the silver price. Financings go up. So in terms of total amount of money raised in 2025 for gold, up to October 2025, it was like $8.5 billion, which is up 120% year on year. And then combined with that, the dashed line is number of financings. So the financings were peaking after the Colorado Gold shows as the bankers, descended upon all these companies. And a lot of the companies that we have in the portfolio that, have significant access to capital didn't raise once this year. They've raised twice. So that is interesting. And I mean, it's the old adage of Pierre Lassonde, when the ducks are quacking, feed the ducks. They're definitely feeding the ducks, and there's more of them. So the other part of alternative investments in mining, so beyond retail, because I did this presentation for the Rick Rule Classroom, I think it was last time or the time before, about, because the TMX Canadian listings, they're not raising as much capital in Canada. They're raising capital outside. There's a lot of reasons for that. Some of it is that, some Canadians or people in Canada that had assets overseas, they were worried that the previous government, which they're probably rightly worried about with the Trudeau government, might stop an M&A transaction. And so a lot of people were listing outside of Canada or reducing their footprint in Canada in terms of management. And so that probably had a knock-on impact. And, a lot of people because, a lot of the retail sector is coming from the U.S. That's where the high net worth tends to be. And I know from my own subscribers, they love to trade on OTC, in New York rather than, do the TSX. So this is just another investor, which would be the strategics. So what you're looking at are transactions, which would be selling would be green. So that's an inflow of capital. For this is Agnico Eagle. So they sold Orla Mining, made a lot of money, like almost 600 million from it. They used a lot of that money to do the other purchases they did. O3 Mining, I think that's Continental, or the other company that's in Colombia. I can't remember what it is. But you can see Foran there. And you see the biggest one was Perpetua. Perpetua is the Midas antimony gold, but it's really gold and antimony mine in Idaho that got its permit, and they have a letter of interest for a big significant capital from the U.S. Export-Import Bank. So financially, they're covered. And this is a $1 billion project to build. Okay, another picture. This is the Ikkari gold deposit, multi-million ounce open pit deposit in Finland. You can see it's basically under a swampy conditions. And on the left is a multi-ounce intersection within a quartz carbonate vein. Quartz carbonate vein. Wow. You can see that sticks out like the proverbial. So the other thing I talked about with the people in the classroom was new entrants into the sector. I've got a few slides on this because this is of interest. So Tether is a stable coin. They tether their coin to mostly currencies, exchange rates like US dollar, Canadian, US dollar, euro, that sort of thing. And their whole goal in life is to basically reflect what's happening in the market, but in more liquid potentially, or speedier transactions, whatever. But that's their advantage. But now they're trying to do that with gold. So they're actually one of the largest purchasers of gold in the market, because they're backing up this new Tether gold coin with their own gold. And then taking that to the next level is the model that I've heard that these type of investors, either it's the venture capitalists in Silicon Valley or these tech brothers or bros, they like the royalty model because they don't want to get involved in the building. They don't want to get involved with the technical aspects. They want to dilute that bit. They want low G&A and a lot of underlying cash flow. And that's where the royalty model comes in. So Tether went and did a big investment in this company called Elemental Altus, which is probably a junior cash flowing royalty company. They bought out two different companies that had almost 50% of Elemental Altus. And with that support, they made a bid on the company I owned as well, EMX Royalties. So EMX, they've been talking to these guys for a while since Tether made that investment. And then the other trigger was the discovery of another copper deposit at the Timok area where they have a royalty called MG. So the combination of that basically triggered the transaction, which was announced during the Precious Metals Summit in Colorado in September. So the big idea is we don't need any debt. So they got rid of Franco's debt, any long-term debt. They'll clean up the whole balance sheet. And it's all about, I think it's going to be a lot of M&A. And they've been doing that. But a lot of M&A about royalties, trying to find royalties. But the problem is that market is very crowded. But they have probably, one of the bigger access to capitals for this size of company, because now Sandstorm is gone. They are probably one of the bigger ones in this size bracket. But the reason I continue to hold is not because of Tether, which is handy because of the access to capital. But the big deal for me is EMX's model about prospect generation. So they continue to prospect generate, and they continue to generate their royalties. And that is the lowest cost, highest return form of actually doing royalties. granted, except for the one I made the money on, which was Origin. Origin actually acquired Renaissance, and that's how they acquired that royalty. But in the end, that worked out very well as well. So industrial metals. So I didn't want to say base metals because I'm going to talk about other ones as well. So this is a picture of a platinum group element, palladium rich with some platinum, nickel, copper deposit called Luanga in Brazil, which I visited a couple of years ago. On the left is a high strain shear zone. You can see those lines, but it carries over 8 grams combined platinum group elements plus another 0.5% of nickel. And on the right is a picture of a drill rig drilling at Luanga. And so what's driving platinum? And let's just go back here. So that was slide 31. So if we go here, I just want to re-emphasize that platinum beat gold. Platinum and palladium, both of them have beaten gold year to date. Even though we talk about gold a lot, justifiably so, silver, platinum, and palladium all have beaten gold year to date. Okay, now let's go back to that slide. Okay, so what's driving the platinum price is, again, similar to silver, is cumulative deficits. So we've been seeing cumulative deficits in platinum. Part of it is demand, rising jewelry consumption because of high gold price, and demand for hybrids, because EVs, people are worried about, how far can you drive? I mean, my wife owns one, we love it, but we don't have to worry about where we can charge it next, or if it's too cold and it doesn't charge. And then supply constraints, because platinum dominates in South Africa, whereas palladium dominates in Russia. Two not great geopolitical risk jurisdictions, but platinum for the South Africans, the issue is power, very expensive, mines get deep, old, higher cost, labor costs, very low productivity. And then what's driving palladium is probably a lot of substitution. So it will come up because people go, oh, platinum's too expensive, now I'll do palladium. And so palladium's riding it up now. So in terms of copper, the big deal is underlying demand, because we've heard about these AI and these places they're very power intensive, which needs copper. But any kind of industrial development requires copper. But on the other side, in terms of supply, the capital intensity of building these copper projects, like shown by Quebrada Blanca, which is the one all the way to the right, which has been suspended because of an issue with their tailings. It's slower in terms of production. The capital intensity is very high. And right now, people don't believe that the incentive price is there to build some of these projects. So you can see red is suspended. Grasberg was suspended because of a mining issue, I think an open pit issue. Kamoa-Kakula was underground, seismic event also at El Teniente. Cobre Panama, as we know, is suspended. There is a risk on the copper price, positive for First Quantum. There is the opportunity risk, depending on the way you look at it, that Cobre Panama with the new government, and maybe a push from the U.S. administration might be able to come back online. So that was at that time about 1.5% of global production. And you can see on the right-hand side the forecast balance, and you could see what they're predicting in terms of deficits. They're even worse than the PGE. So we got like 5. Well, if you include one that was flat, you got 3, 4, 5, 6, 7, 8 years of deficits, cumulative deficits, dragging down the global inventory. So when I worked as a market analyst, it was easier to monitor the inventory looking at all the exchanges, whether it was the London Metal Exchange, the COMEX, or the Shanghai Exchange, which was just starting in the early 2000s. The problem now is because the smelter capacity, 50%, is in China, and it's also by far the largest consumer of copper, it's harder to know where the inventories are. So even though you have a deficit, you might still have a global surplus. So, but the amount of years we've seen of deficits and the forecast for more deficits. So, you know, these deficits, I mean, 2025 is still a surplus, but the problem is the future years. And that's why development makes so much sense, especially if you can find, you know, a project that's not very capital intensive. Maybe one that's not above 5,000 meters, one that's got no power and needs a road, that sort of stuff. You know, you want to find one that can compete in this market, especially with respect to capital intensity. Okay, this is something important, is what we call the treatment charges so smelters charge companies. And so this is a way of knowing the supply-demand dynamics for copper concentrates. So if the TCRCs, the treatment charges and refining charges, are high, that means that supply is low of concentrates, or there's a lot of smelter expansion. So either way, the balance is in favor of concentrates. And so that's why the concentrates, you can see that the TCRCs have gone negative. And that's why, because people are paying you, the smelters are paying you basically to give them your concentrate, because they can't not run the smelter. They have to run the smelter. So they need feed. So the ones are paying more. And so what China has done to try and stop this is they've, you know, limited smelter expansions to stop the demand problem. So the purple line best exemplifies what's happening. So back in 2023, the TCRCs were about $75, $80 per ton, the treatment charges. So that would be 8 cents per pound on the refining charge. And then you can see by early 2025, they went neutral. You know, basically it wasn't a cost anymore to a producer. And now they've gone to about $60 per ton they're paying you on average. And so that's one market. And when you look at the LME price, the COMEX price, or the Shanghai price for copper, that's one thing. But if you want to look at real dynamics, and you know, I learned that when I was a copper market analyst for copper, you look at the cathode premiums, then you see how tight the market really is. And you can see the jump in cathode premiums in Rotterdam, which is for Europe, and then you could see what's happened in China. It's come off a bit, but there's a premium out there for having for cathode. If you've got cathode, you get paid extra, more so than people going to the inventory of the LME or the COMEX or the Shanghai and buying it themselves. And then you can see another graphic, the same sort of graphic of spot treatment charges. So this is a mine I visited recently on my last trip to Chile and Argentina. This is the Caserones mine. You know, a lot of that looks like it's Photoshopped because of the colors, but yeah, the Japanese built this. Lundin bought it, and they continue to operate it. I was looking at the exploration upside outside of the known Caserones open pit, which are a bunch of breccia pipes. But you can see that they painted everything green, and it stands out remarkably there. But anyway, you can see that they basically have enriched copper, but they actually process it. So they crush it, mill it, and produce a concentrate from the enriched material. Usually you leach the enriched material and produce cathode. That's not what they're doing here. But what they are doing is leaching low grade stuff that they leach that, and they get about 50% recoveries on that. That they produce cathode. Okay, a few more slides here with the record move in base metal equity. So this is the XBM. So this is since the end of October 2011. So you can see the XBM before 2020, you know, its peaks were around 15 in terms of the index. And then after that, it started moving. The last significant peak was around 2022 during COVID, when we had supply chain issues. It got up to 25 almost. got there again in 2024 in July, and now it's broken that. This is the highest it's ever been at 30. Okay, so just remember that. So even though we're high in GDXJ, you know, historically we have been higher. We've never been higher with the XBM. Okay, and so we can see how that translates to financings. So first 9 months to September of 2025, $3.18 billion was raised for base metals. So this would include copper. Copper is probably the majority. And that's up 30% year on year. Number of transactions increased by 12, and the average amount raised per transaction went up about 17% to almost $5 million per transaction. This is another project I visited during my trip to Chile and Argentina in October, I think it was. I was down there for about 2.5 weeks. This is the Valeriano project, a copper project with some gold in Chile. And during Rick Rule Classroom, I talked about this deposit at more length because it basically was showing an example of what I call hypogene copper enrichment. And here you can see the drill rigs there. Within what's basically the middle of the resource of what the Valeriano is. I mean, at the bottom of that, you know, valley, it's another 200 to 300 meters to the top of the deposit. Okay, and so out of this, we've been talking about a tech merger. Anglo-American and Teck, and this has now been passed by the Canadian government, which was one of the big hurdles. Like they announced at that time, there was a merger of equals, but really Anglo is taking over Teck. $58 billion. Both share prices went up. They're looking at $800 million of annual pre-tax synergies. There's synergies there with Quebrada Blanca 2, which is huge because Quebrada Blanca 2 is the one that's running. Basically, it's the one that forced Teck to go into this mode of being looking to get acquired because their balance sheet just was horrible. But anyway, and then the merged company will have a 70% exposure in copper going forward. And so even though we don't like to talk about big companies, but this is a mega merge. But you can see the problems Teck have been having. So the first column is the first half of 2025 versus the first half of 2024. So profits, you know, have gone up. They made more money, 72% more in terms of gross profits. But in terms of free cash flow, you know, they've gone down to about, they've drawn about $1.15 million as opposed to drawing about $900 million. The only reason that they have a decent balance sheet was because they sold the coal assets. So the end of last year, you know, that was the over $1 billion they had of a cash injection. They didn't get that this year. This year, they basically paid a lot of debt off, so that was an outflow. So their change in cash was about $2.5 billion. So they, I mean, overall, they reduced their net debt from 3.7 to 3.2, but they're still sitting on a big debt position. And so this is something Anglo can help out with. Okay, I think I've talked enough. So we can go into the Q&A now.
Okay. Awesome, Joe. Thank you very much. And to everyone that's a part of the Rural Classroom Plus, you know what an asset Joe is, having a geologist literally on call once a month that you can ask any questions you want. And Joe, I just got to say your call on copper has been really profitable for me. I took your advice over the last 2.5 years and basically just bought copper on pullbacks and have looked like an absolute genius just following your advice on that.
Well, you're making me look smart. That's good. I appreciate that.
Yeah, it's very profitable. So if you guys are on the fence about coming over to the Rural Classroom Plus, I got to give Joe a real shout out there. Okay, we got a question here about where'd it go? I just lost it. He's asking about Joaquin Matthias and Argenta Silver. Do you follow them down in Argentina?
Well, that project as well, I've known for a while. Kevar was the original project. It's high-grade silver, and just like a lot of these projects, people sort of got focused on development, and then they lost the exploration side because they can never raise enough money because it is high, and it's not cheap to drill up there and constantly raise money, but it's not precarious in terms of where it is. You could drive up there. It's quite accessible. And that part of Argentina, it used to take me 12 hours to get to some projects up there. It's about half that time now. So the access is much better. What I would watch in that project is just the metallurgy, just to make sure that that's benign, that works. That would be the biggest deal. The grade's definitely there. The tonnage would be, does it go out beyond the veins to get a significant deposit, or is it going to be like high grade and small, which is not hurt Highland silver, at all. That's done quite well in terms of that. And I think when Silver SSR Mining had it, they were looking at only a 400 ton per day plant for that. But that might be where it ends up anyway. And that might be why Highland Silver bought, who did they buy? They bought a company recently. God, I can't remember who they bought. But anyway, they're combining with another company, probably because they might see some tonnage constraints where they are. And also in Peru, there are still issues with gaining social license to operate access, community access. It's there, but it takes a little bit longer than some other places. That's not an issue for Argenta or anybody like that. That's not a big deal.
Okay. Hey, Steve, unfortunately, I got to have to cut the Q&A off here because we're into the 4th hour and our next guest is already here. Joe, thanks for a great lecture, and also thanks for a great year, actually. Steve's absolutely right. The stuff that you've put up on Rule Classroom is just amazing, and if you were able to ingest it and act on it, you probably did really well, because just really great insights. So guys, if you're new to our channel, Rule Classroom is a private investor community, and we run it with Rick Rule. It's there are a lot of introductory courses on there that you can sign up and watch for free. But if you want more, we have a private enhanced members section called Rule Classroom Plus. That's where Joe comes and does his monthly lectures. We have Adrian Day, we have Joel Littman, and then of course the weekly live streams with Rick Rule and Steve, where you get priority access to ask Rick questions in the live Q&A. So it's an incredible package. Go to ruleclassroom.com. You can learn more about it. And if you sign up before the new year, you can still take advantage of a discounted price. So recommend you do that. There is also a pretty lengthy free trial too. So you have nothing to lose. You can cancel without penalty and pay nothing. Members also get discounted access to our boot camps live and the archive. So please, if Joe's lecture was interesting to you, please check us out at ruleclassroom.com. Once again, Joe, thank you very much.
Thanks, guys.
I think, it was very nice, like I said, working with you this year, and thanks for taking time on Boxing Day to deliver this lecture.
No worries. Thanks, guys.
All right.
Appreciate
it.
Thank you, Joe.
All right, Steve. On to the 4th hour.
Yes. I just pulled up something that might be of interest to the crowd here, since silver is hitting all-time highs. If you could let me just share the trading view chart.
Can you hold that for a sec?
Oh yeah.
No, because we got to move on. We got almost 4,000 people on the stream now, and some of them may have just joined. So I want to play Rick's holiday greeting before we bring on Nomi Prinz.
Okay.
This is Rick Rule. On behalf of everyone at Rule Investment Media and the Rule Classroom, the Rule Symposiums, and the Rule Newsletter, wishing all of you the very best of the season. Happy holidays. Happy, whatever you'd like to call it, Christmas, Hanukkah, best of the season to you and yours from all of us. We've had a spectacular 2025 in terms of our programming, in terms of our markets, in terms of our growing share among customers like you. It's been a delightful 2025, and I'm convinced that 2026 will be even better in every regard. Our programming improves, our audience increases, and our market is in an upward trajectory. It has been lovely serving all of you for the past year. It's been lovely corresponding with all of you for the last year. It has been lovely watching all of you interact at the classroom and at the symposiums, in the boot camps. We look forward to a lot more high quality content, a lot more audience participation, and we look forward to a very, very, very supporting market. Once again, from all of us, all of the staff at Rule Classroom and Rule Investment Media, to all of our audience, best of the season. Thank you for a spectacular 2025, and we look forward, pardon me, to an even better 2026.
All right, and if you're just joining us, welcome to our holiday live stream. I'm Albert Liu with Steve Barton. It's been a great morning so far, Steve, and a lot more to come. And with that, I want to welcome probably one of the favorite speakers at the Rule Symposium for many years. Since I was back working at Sprott, actually, she's been blowing away audiences at the Rule Symposium. At the time, it was the Sprott Symposium, and so happy to have her joining us for the second year in a row for the holiday live stream. Dr. Nomi Prince. Nomi, thanks for joining us today. How's your holiday been?
Thank you so much. It's been really great. Nice to step back and kind of observe people and commodities and hang out with family all at the same time. So thank you. And thanks for having me back. And to all of you here, wow, 4,000 people on live stream. That's a lot of people focused on a holiday Friday. On what's really important in terms of investment, preserving family wealth, being involved with Rick Rule, with Albert, with Steve, with just everyone who has such good information and high quality insight. And I'm just honored and gratified to be here today.
Well, we are too, Nomi. It's really what you give up is an indication of what you think something is worth, and that so many people, including guests like you and everyone who showed up, would take time out of a holiday to do this is just great. So thanks very much. I think maybe to start, Nomi, for about 10 minutes, maybe, I just want to give you the floor. And could you just summarize, I guess, what you think is more important, either where we've been or where we're going in 2026? Just some thoughts to get the conversation started.
Sure. So right before this conversation, well, basically two things were going on. One is I was actually talking about the commodity markets with my niece, who is 16. I started having her consider what investment was by buying her silver coins. Well, actually, my nephews and my niece every year, in terms of just a holiday present as well as a birthday present. So two a year. They've appreciated substantially, but also just what hard assets with real things actually mean. And we've had such a phenomenal year in the real asset space. And Albert, you mentioned some of the that I've been at talks at Sprott, and of course at the Rule Natural Resource Conference, multiple years running in Florida. And I was talking about the titles of where real assets were and sort of where they're going, which is all quite very exciting to her as well. And in 2024, I talked about the real asset big boom, which was basically a lot of these assets coming in play, gold, silver, talk about them, but sort of on the outset, what's the economy going to do? Is it about inflation? Is there more at play? But really that sort of big boom, that sort of moment of real assets coming back into the limelight. And in 2025, we saw what I call the real asset uprising, which is they didn't just appear, they took root. And for a lot of different reasons that I'm going to get into really quickly. And I think right now, as we head into 2026, we're moving from a big boom to an uprising to an escalation of the importance of real assets, and therefore the importance of investing in real assets, and in particular of finding the right investments and at the right geopolitical moment to maximize those investments, all of which we talk about so frequently, and that you discuss so much here at the Rural Classroom and in other forums that are related. So really quickly, we all know this. We have to give a hat tip to silver, which is racing up in honor of this conversation to almost 80, and other types of assets. And if we look at just how things have performed, which I'm sure other people have talked at, but why they did, and sort of where that means it's going for next year. We had a silver boom of 152% as of us talking right now. Our target at Prinsights was 50. That was exceeded substantively. Our target for 2026 is 120. I can get into why. Gold, of course, started the year 2,800 ounces. It's now touching past 45.53. Our target was 4,000 back in January, and we moved it to 4,500 in September. That has been hit. And is moving past that. Copper was at 399 under 4. It sort of bumped up to around 5 in the middle of the year. And then there's all this conversation about how China was going to fall apart, how the economies are all going to shrink, and how copper wouldn't really be a thing for a minute. And we saw a dip there. Now it's heading up towards 6. It's around 582 as we speak, up 46%. We see copper as one of the standouts, and going to like 750 as a target for 2026. Uranium, one of my all-time faves, because I've been involved in so many conversations on a bipartisan basis in Washington, in the Houses of Parliament in the UK and other places around the world about the importance of nuclear energy and baseload uranium, components of that, enriched uranium, the whole processing downstream, midstream components of uranium. And the government has reissued its U.S. critical minerals list. Of course, uranium popped off. It popped back on this year. Copper's on for the first time. Silver's on for the first time. Those are added bits of momentum. And we see silver going to 110 in 2026. And we thought it would go to 80. It's at 82. There are reasons for that as well. And then the standout of like the top 5 commodities, I think is platinum. And we have to give a hat tip to platinum. Again, reasons for that structurally. Currently at a percentage change of about 167%, going from 950 ounces back in January 2nd to about, I don't even know what it is as I'm sitting here, it was 2470 like 2 hours ago. But certainly zooming up, and I see that around 34 to 3600, passing historical highs going into 2026. Of course, palladium's had a great year, up 89%. Rare earths, of which I'm particularly involved in because of my position on the board of Meteoric Resources, has had a very upward year in terms of investment, particularly by the U.S. government, investing in MP materials, but also looking at other projects midstream and even downstream, and also offtake agreements. And I can tell you right now that those conversations are happening, maybe not at this moment because Congress is on holiday, as is the DOD and DOE in some respects, but it's definitely going to pop up more as investment in uranium and uranium facilities and processing is going to come out. There's 3 other commodities we're looking at for 2026, lithium, cobalt, and nickel. They're a bit less popular, but certainly are on the upsides. And so I've ranked them coming into this call, and I'll stop for questions. And our ranking, it's determined on 6 basic factors. First is the supply response, how long it will take for any supply deficit to current or escalating demand. I'm going to talk about real asset escalations, escalating demand, current demand, and what the supply response time will be in terms of what supply is above ground, where it's at in the processing stage, and how it can filter into real demand from markets in terms of new supply, considering it takes multiple years for permits, capital raises, and other types of infrastructure requirements around existing mines. Second is inventory buffers, like how much is available, where is it stocked, or is it gold in vaults, is it silver in vaults, is Is it copper in reserves? And where are these assets that are already out of the ground? Where they're going? How are they going to be capped in terms of price versus rationing to demand? Third, market size, respective market size. I can get into that more detail, but that's another one. Fourth, demand structure. What's the physical demand versus the geopolitical demand? What's the must-need demand, and what's the strategic defense demand? And fifth, really importantly, coming into this year, more so than ever, I think, is jurisdictional concentration and risk neutrality in jurisdiction. Where is the mine? What's the government like around the mine? What's the relationship of that government to its local population and to other countries? And sixth, in general, changing policy and trade intervention, or just trade flows or trade logistics. So those are 6 things. So the ranking we have, and again, then I'll stop, I said that before, is in terms of upside ranking, taking all these factors and predictions into account, is first is silver, second is uranium, third is copper, fourth is platinum, fifth, which surprised me myself, it wasn't first because it's been first for me over the years, is gold. 6, palladium, 7, rare earths, in particular, neodymium, praseodymium, because that's the NdPr, the light oxide that's important for permanent magnets and defense. And then cobalt, lithium, and nickel. So with that, I'll just stop for now.
All right, Domi, thank you.
There we go.
Well, you're in a tough business, trying to make these price forecasts, but well done for 2025. Just extraordinary work.
Yeah. Can I just hit this real quick? Okay, so you look at 6 different factors: supply, inventory, market size, demand structure, jurisdictional risk, and trade flows, and you kind of use that as your formula. Number 1 is silver, uranium, copper, platinum, gold, palladium, rare earth elements, and then in last is cobalt, lithium, and nickel. When it comes to market size, I'm wondering if it's a smaller market, does that kind of move it up the list a little bit because it can be more volatile, or?
Yeah, that's a really good question. So I'll answer that first with platinum, which has again outperformed all of those other commodities this year by a hair to silver, but still, and one of the reasons that happened, and it's kind of higher than gold in this particular ranking, is that the jurisdictions for the availability of platinum are very limited, right? So we have South Africa, which produces about 70% of the platinum that's available for EVs, for mechanical infrastructure techniques, for defense, et cetera, defense metals, et cetera. And all of these assets, by the way, with the exception of gold, are on the U.S. critical minerals list as of this year, including the newly added one, silver and copper. But when you have jurisdictional risk like that and a smaller market size like that, those 2 factors sort of work together in terms of when demand grows relative to supply, or jurisdictional risk increases relative to supply above ground, and there's fewer mines coming online around the world. Basically, not going through all the sort of math and the conversations behind it. It's not just math. This is also looking at dynamic policy. We tend to get more of those upside when all of those things are pointing in the same direction. If you look at something like silver, where a lot of new mines, including ones I know we cover, that have been covered here, things like Abra in Argentina, things like Aya in Morocco. You have new, solid, high quality mines in sort of further stages of permitting or production of testing or whatever that might be, adding to another big jurisdiction, which is, say, Mexico, where you've had some risk, it's been alleviated. So we look at basically all of those factors, and then these pool of demands. It is silver popped on the critical minerals list. Platinum's already there, but you have these added problems. Then you take in the Russia component. We've had a lot of volatility around Russian supply for PGMs. Clearly for uranium, and how does that come into play? And that can change. We can have a positive moment with Russia if it looks like we're going to have some sort of resolution in Ukraine, and then we can go back to have a negative moment. And so we kind of look at the shifting parameters, and all of those things really interplay.
Okay. But silver you like is number one.
Buy it, yeah, because yes, throwing all that in, and again, silver has an additional factor which is not quite in there. I put it more into policy, a monetary policy, so the sixth factor, and none of them are any more important than the other. They're just six factors. But policy and trade includes monetary policy. And one of the things that can happen with silver, it's happened in past history, is silver can be adopted as more of a central bank reserve currency, not necessarily by the United States, but by other countries, or even by the BIS, which I'm sure is considering that. So if that happens, it creates an additional upside for silver, even if it doesn't happen, but it's being more discussed more publicly, it does. So that's why silver is up there, as well as all of its industrial uses and the supply deficits and all of that.
Okay. I'm looking at the spot price of silver right now, and we're at 78.90 on the COMEX, and then in Shanghai right now, if you convert it to dollars, it's at 85. So hopefully that's a little precursor of what we'll see in America. I don't know. Pretty exciting.
Well, it's interesting you say that, because that actually is another subcomponent of location, of jurisdiction and location, because it's also where is this supply being traded and where is it being stored, and if it's being stored more for whatever reason in a particular locality, gold is this as well, in a vault in wherever it might be. It's still taking that above ground supply out of the market, even though technically, if it weren't being stored, it could be used for, say, industrial purposes or monetary purposes. And so all of that's a really interesting trend that's popping up.
Yeah.
And that's why your prices are different. You have more of a scarcity factor, for example, in Shanghai, and gold is a bigger traded market, so you don't quite see that as much. But you just have more of a storage for both geopolitical and wealth reasons, but mostly geopolitics from that perspective. And so you see kind of a commodity bid offer spread, I would call it, for some of these locations. Yeah, exactly. Yeah.
Yeah, we saw a little bit of that at the LME and then the COMEX. And so we drug it over, and then it looks like China's taking it from us now.
Yeah, exactly.
Yeah.
So, guys, I want to welcome two more guests to the stage and maybe get some of their questions or insights. My friend Jason and Lovis from Covered Call Podcast. Guys, welcome. Merry Christmas. They're coming in from Germany today, so thanks for, I guess, staying up. Appreciate it very much.
Hey, no, thanks, Albert. Thanks for giving us the chance to take part. Really exciting.
Yeah, Albert, I've actually since jumped over the Atlantic, and I'm in Texas now.
Oh, is that right?
No.
Oh, okay. All
Yeah,
right. Well,
so-
welcome back.
Thank you so much for having us. Really appreciate it.
Excellent. So any questions for Nomi? They were backstage when you were talking, Nomi. So yeah, any questions for her about the talk, or any comments you want to make about this sort of how these global commodities are stacking up?
Yeah, I actually wanted to ask, seeing how these commodities are becoming, the pricing anyway, becoming more volatile, and also with supply chains becoming so much more strategic. So if we just, let the thing play out, and let's say we see ourselves in a world where commodities, relatively speaking to all the other financial assets, become way, way more important, what are some of the things we need to look out for that's maybe not in the commodity space, but is actually going to get affected by commodities doing what we all think they're going to do?
That's a great question. One way to answer that is to consider that some people still think of the bond markets as an investment. I never really have done that, but so I look at equities, I look at commodities. Of course, bonds finance things, and some of them even finance mining and supply. But one of the things that we saw a couple months ago is that Morgan Stanley, for example, moved their allocation suggestion from 60-40 equities to bonds to 60-20 and 20, and sort of dividing what they consider to be an optimal, and this is all old sort of portfolio math, but an optimal portfolio of investments, dividing the bonds in half and basically giving them to commodities. Interestingly, that's sort of what China has been doing for the last 4 years, which is they took a $1.5 trillion position in treasuries, when our treasury debt was like way less than it is now, but they cut it in half, and they've been increasing their gold supply, which is currently about 5.5% of their portfolio. In general, central banks have a long way to go actually to get to the percentage of gold that they had just in the wake of the 2008 financial crisis. They're still about, in total, about 1.5%, 2% less than what they could be, forgetting all the geopolitics that's happened since. So that's, again, a massive pull on gold, and that attracts the attention of asset management companies like Morgan Stanley, private wealth investors, sovereign funds, the potential of pension funds and insurance companies to take out what they consider now generally a 5% asset allocation allowance to what they call alternative investments, which actually include commodities right now, to potentially looking at altering that alternative investment bucket to be alternative investments, which are like, leverage, like commercial loans and weird bonds and stuff, into having a separate commodity bucket. And if you start to have that allocation, you're not just looking at finding the real assets, you're looking at finding the miners, again, that are in the beginning of or far along the way of producing into this growing demand. And so this is, it's a potential to be a multi-years reallocation of how people perceive commodities. And I know we've had other cycles like this where certain commodities have popped up, like, uranium has gone nuts, or platinum. We're still not at its 2011, I think, high. But whatever the case may be, in this commodity cycle, everything is up. And everything has similar underlying reasons, like some of those 6 factors, and I'm sure other ancillary factors, all of which are pulling the perception of commodities as a financial investment higher, while the structural deficit is continuing to grow as well. And so both of these two things are happening at the same time. So I think that changes a lot of where the world is. It also will begin to change competition for not just the assets, like China hoarding copper, and like the US putting copper on its critical minerals list for the first time this year, but it will also, and it has already, but I see this happening faster and faster, not maybe all of a sudden next year, but over years. It means there's going to be a lot more buying of mines, and there's going to be a lot more funding of new operations and operations in midstream. There's going to be a lot more consolidation in the mining industry from a financial perspective. And there's also going to be a lot of mines that just don't make it, as there always are. So it's going to be important to choose them selectively.
Nomi, being placed on the critical minerals list, what's the implication of that? So I've heard that a couple of times now. So the US is doing it. I heard a rumor that something related to silver might happen in China starting January as well. But what does that mean? Does it mean the same thing all over the world? Does it mean just no more trade, no more export? Like what happens to those minerals on the list?
Yeah, that's an excellent question. It's less of a trade thing at first. I mean, although of course copper, there were tariffs on copper. There's tariffs on some of these minerals, not gold. There was for a second. It got walked back. Didn't even really make land. But what it means is there's a geopolitical, or there's a national interest in ensuring that they have enough access to as much of the supply chain for that mineral as they possibly can. And that means the same thing to countries that are, I'll call it like the top of the superpower sort of pyramid. Obviously the US, obviously China, other countries in there, Brazil, India, and so forth, that have both a supply, but also either a lack or an overabundance, if you look at China, of production and processing capabilities, and also this issue of time. You can't just put up a plant, you can't just create a mine. So what the United States has done by initiating the list, which was in 2018, and having 2 revisions, this is the third of it's the third time, it's the second revision of having sort of copper and silver get on there, it's basically saying, look, this is important to us strategically from a defense perspective, and that's where this comes from. It goes out through the Department of Interior, the Department of Energy, but it's fashioned as a strategic defense material. It just means we have to be careful. We have to finance the supply chain. We have to be growing the supply chain again throughout, from upstream to downstream. And it's important to our policies as a nation. So it's much more than just stockpiling the asset. It's about the entire supply chain and what it means to what will be needed in terms of securing sort of national interests. And that's similar. It's for the bigger countries. Something like Brazil, they have a critical minerals list. For them, it's a bit different. For them, it's like, how do we actually keep control of these, and how do we grow our processing capabilities to not just be an output of these hard raw assets, but also be part of the economics of the sort of global security chain. So it's a lot of different statements in that list.
Okay. We got a question here in the chat from Lev. He says, how long do you think the silver price will hold up? His assumption is it's a speculative market rather than a long-term play. What do you think?
So every market has an element of speculation in it, right? I mean, I mentioned copper sort of hit 5, went back down. Everybody thought it was kind of over, and now it's kind of popped back up again. So there will definitely be ups and downs in silver, and there will definitely be, and I could see that being what's happening at this year end. There are traders in there trying to drive up the actual price, the futures price, in the absence of real supply movement one way or the other, and in the absence of a lot of volume trading in general, because the holidays are thin. I mean, when I was on Wall Street, we used to love trading thin markets because you could move them, take profits, and leave. And I think we can see that. We can see that in SLV as an ETF. It would not surprise me if they took profits either before year end or in the beginning of year end. When I say they, I mean whoever's trading in large volume. But the structural reasons that elevate that ability to trade are less speculative today for silver than they were, say, 5 or 10 years ago for silver or for uranium or for other types of commodities, because of all of those factors that require silver in terms of geopolitics, critical minerals, supply deficits, industrial development, solar development. These 200 million ounces of deficit per year and growing. So these are all structural things about silver that will ultimately keep its upward trajectory. I think when there are dips, and there will be, because there are also speculative players in the markets, those are simply good buying opportunities.
Yeah. Okay.
Hey, Naomi, here's a great question. Sorry, who did I interrupt someone?
No, you're good.
Here's a great question from Baba Knight. Is concern about inflation contributing to interest in commodities? And if you think about China in particular, turning dollar holdings into foreign direct investment, expanding Belt and Road, that is directly, that is essentially that, right? It's fear of inflation, or fear of confiscation too, I guess, but inflation getting turned into projects on the ground. Naomi, can you think of other examples? Or first, do you agree with that? And can you think of other examples where that's true?
Yeah, first, I think a lot of this component of this commodity run began in a period of inflation, of high inflation. It began with the confiscation of Russia's assets in the form of the liquid assets, and it started this pivot towards gold of central banks, and that's something that won't stop, because it wasn't just that this recatalyzed that desire to have sort of hard assets diversify against the dollar. That was already happening. But it just allowed for reasons to accelerate the process that I don't think are gonna, are gonna turn around. And then other commodities sort of piled into that. I think, as we get to this year where inflation, 2025, where inflation is not really a thing. I mean, it's still in headlines, But if we're looking at 2.7% or even 3% inflation, I know that's above the Fed's sort of fictitious 2% inflation target. But the reality is we had that inflation level before COVID. These are not abnormal inflation times. It's just that we did have a period that might have catalyzed renewed interest in some of this as a hedge, a currency hedge, an inflation hedge, a policy hedge. But right now, I don't think that that's the overriding actual reason that a lot of these commodities have been lifting or will continue to lift. It's a reason. It's a reason that I think media likes to draw attention to. It's a simple reason. And honestly, I think by the time we get to a new Fed chair in May, the idea that inflation is sort of tied to the Fed policy and other sorts of, headlines that don't really take into account any of those 6 factors for assets, I think we're going to see that inflation won't really pick up just because the Fed will inevitably reduce rates more quickly or re-invoke QE because of other pressures in the financial system away from assets.
Silver just crossed 79.
If
79.50.
we keep talking, it'll go to 80. Like, we just have to keep talking.
Yeah, exactly. Yeah.
That's
Oh
crazy.
man, this is
I got
incredible.
sick 3 days ago, so I've been in bed, and when I woke up, gold was over 4,500. Just unbelievable. I should get sick more often. It's absolutely crazy. Can I steer the conversation in a slightly different way then? Jason and Lovis, they host a podcast called Covered Call, and you do a lot of like society and culture, but also like geopolitics and economics, guys. Can you sort of pinpoint any themes that stuck out for you in 2025, like recurring themes or important themes that came up with guests? Just for people who don't know, this is a great podcast, not just because they interview a lot of my friends, like Rick and Stefan Kinsella and people like that, but I discover people on your show that I wouldn't have found elsewhere, which is what's really valuable about it, and fresh ideas. So does anything stand out, guys?
I mean, I would be amiss if I didn't say the whole year stands out, because Jason and I only started this podcast less than a year and a half ago, maybe a year and a quarter ago. And originally we had set a goal of saying, we're not going to quit until we hit 10 episodes, because there's a statistic that every podcast that starts, I think 90% of them never cross 10 episodes and they get abandoned before that. And so we're almost at, I think we just published 29, which is not a great number to publish in a year, but we focus greatly on quality. And so we started off the year with our original whale that we had said that day when we decided to do it, and that was Luke Groman. And he came on, and I mean, it's rare to have a conversation with somebody who's like so prominent in this in any particular circle, right? But it's such a clear thinker and can articulate like complicated big ideas so easily. And that was just January, right? So and we've had Rick on a second time, which is our best performing episode to date. He broke down the arithmetic of America for us, which he also talked about when we saw him in person there, and when I met you in person, Albert, in Vancouver. That whole event, meeting everybody in person in Vancouver stands out for, of course, personal but also professional reasons. I mean, as far as themes go, of course, the theme that Nomi was belaboring with a wink, right, is, I think it's so present, and it actually like when you're in this bubble, so to speak, I think it's something that we all think about a lot. But then when I kind of go outside, and so for example, we did Christmas here on New Year's Eve with my wife's sisters, and of course my wife is about sick of hearing about gold and silver and Bitcoin and geopolitical change and all that stuff. But so she was like, "Hey, what's a good gift? what's a good gift to give to my sisters to get them into investing and saving?" And I was like, "Let's give them an ounce of silver each, right?" Which So we did that, which then of course gave me a chance to give a quick sermon at the dinner table. And it, they're all professionals, have jobs, have their own lives, and they have spent exactly 0 time thinking about gold and silver and geopolitical change that's happening. And that's something where I'm like, man, it feels like, I'm sure to somebody like Rick, who's basically been talking about this his whole life, but then you meet people, or average people have literally not thought about this or hasn't crossed their mind at all. So it feels like a good place to be in, because I think it's important, and it's getting increasingly more important. A lot of the predictions that have been made, right? The broken clock is right twice a day type of thing. That used to be, I think, but it really does feel different with the shifts that are happening right now, because they're so monumental. And it's more than just a run up in price in these critical minerals. It's really that, like, whole systems of global trade are changing, right? So what's happening with BRICS, like turning away from debt-based collateral, and pivoting more towards and establishing gold and silver-based or commodity-based collateral system. I don't think it can be overstated how much that's going to change stuff, how the world works over the next couple of decades, And so everybody that says like, well, BRICS is a joke because they don't trust each other, it's like, well, I think they might be well aware of that, and that's why they're doing a collateral standard that you don't have to trust necessarily, right? So that's my thought anyway. Maybe.
I think that's a silly assessment. Not what you said, but the idea that BRICS doesn't trust each other, because I don't think anyone trusts each other. I mean, that's the point, right?
Yeah,
I don't think anyone does. But yeah, the psychological aspect, that would be very interesting if that changes, because when I started, investing in gold, just first as an amateur, all anyone wanted to talk about were tech stocks. And then when I went into the business, I was trying to sell bullion to people who were making tons of money in real estate. And then when I started at Sprott, it was selling against people in crypto. And it just kept, like, the new thing just kept coming along. But in the end, you look at a quarter century of gold performance, it's been phenomenal. If you look, Steve and I were talking about gold versus your average real estate investment. And if you go unlevered, just cash, the real estate gains were not that great. If you were in a great area, that's different. That's sort of, picking the jewel. But if you just take on average, unlevered, gold has done very well. Jason, same question for you. In terms of themes, is there something that came up that you thought just sort of represented to you what 2025 was?
I feel like with nearly all of our guests, right? Like what Nomi was talking about earlier, I think if, let's say, we were to quote Warren Buffett, right? He said something like, it takes 20 years to build your reputation, but 5 minutes to lose it, right? And I think we are going through this phase shift, right? But where a lot of collective reputations are being lost within 5 minutes, like just like what Naomi said with Russian reserves getting seized. But that's just one event of many, right? And so when the whole structure with which this really efficient globalized world we live in is running on starts to show, signs of changing, I think it's really important to be aware enough and flexible enough to then make decisions on an individual level that everybody needs to make. And the cool thing for me was having the chance to speak to all these different people in different fields, but one thing they all had in common were, I think, Lovis, you'd support me to say that they're all critical thinkers and independent thinkers, and they were able to share with us, let's say, philosophies and how they would apply certain philosophies to the ever-changing landscape we see in front of us. I think that was what was very valuable for me, right? To see that there's so many different individuals, but as long as they were, let's say, like I said, aware and open to the fact that things in the future will not be like how they were just yesterday, that they were basically pretty okay. They weren't too stressed out, right? They knew that they'd be able to handle things. They just had to see things for what they really were. And yeah, so that's what I took away from all these really cool conversations we've had.
Yeah, on the theme of global shifts, Jason, I earlier in the stream we had George Gammon from the Rebel Capitalist channel join us, and he was talking a little bit about a sort of the place of the dollar, and in his view, he thinks that sort of the narrative of the end of the dollar or the dollar displacement is overdone, and his point was that there's just so much dollar infrastructure, right, that the global financial community cannot stop using it. And he makes a good point there, but I think there's another point that maybe he's missing or he's not looking at, and that is sort of the power dynamic, because Russia was not supposed to be around still. Right? Russia was supposed to be gone as soon as the sanctions went on, and because of bilateral trade, not a new dollar, not a new global currency, but just because of bilateral trade and partners, they're still around. And this is happening all throughout the global south, right? And so yes, the plumbing is not going to get disturbed immediately because there's just too much of it. But if you're Russia and you know that someone can just turn off the tap anytime, you're going to find another means to supply yourself, even if that means just carrying buckets of water, right? That's better than plumbing that can be compromised at any time. And that's, I think, what's going on. It's pretty obvious that that's what's going on. So I want to ask Naomi this question. Are we sort of overstating the significance of what's going on in terms of BRICS and the move away from the dollar, or are we understating it?
I love that question because overstating it is saying the dollar is dead and it's never coming back. And I'm oversimplifying the overstatement, but that happens out there. The dollar is declining in terms of its relevancy in trade. It's also declining in terms of its position, for example, in the SDR or in central bank reserves as a global currency. And it's also competing with policies of countries that have figured out what's necessary for them to be powerful. So if it's a question of Russia, yeah, sanctions can be put and they were against Russia, but natural gas is still going to flow, and enriched uranium is still needed by us. And even when we quote banned in a legislative act uranium from Russia, there was a 3-year clause in it to say, but unless we actually need it, we'll kind of find a way. And that's just one example. With respect to China, we've had 2 decades of an evolution towards processing of most of the materials that we need into China, and this is what's going on. They're not going to stop. They're not going to all of a sudden buy $750 billion worth of treasuries back. That's not going to happen. So one of the reasons that the dollar sort of diversification versus death count is going to continue to happen, and it is important, is because these nations, net of the military might of the U.S., which is a separate thing, and obviously also anchoring the dollar, are figuring out how to work with each other. And really, really quick, because I love history, and I just started a new book, so that means I went back to 1873, when the Coinage Act was passed by Ulysses Grant, President Grant, which basically took the U.S. off of a sort of fuzzy banknote / silver system and basically said we're going to go into a gold system, which didn't become a gold standard till a little bit later. But at that time, the gold standard was being used in trade, basically started by Britain, who had a central bank since like the 1690s, in order to back their trade. And so we look at the chain of commodities. We look at gold becoming more of a component of reserves, which means more of a component of financial systems around the world, which means more of a component of collateral for trade. Payment systems are easy now. it's very easy to stick programmatically gold in as a component of collateral for trade. Once you have the platforms, once even the digital platforms, which we're seeing competing payment systems from China, from Russia, from Brazil, merging together, talking to each other. This is all about the flow of money, which is how the United States has really been so supreme since 1944, plus the military. So I don't see this changing. I don't see a walk back of other countries' desire to secure their supply chains and to secure the collateral that backs their trade and to secure their reserves. Is it going to happen overnight? No. Is it going to happen in our lifetimes? Maybe not. Maybe gold just stays below the dollar and above the euro in terms of its reserve percentage, but that's a pretty high up in not too, in just a few years. And so I think that trend continues to happen. And I think I think if anything, there's a war for the commodity supply chain, not just necessarily individual commodities. It's just beginning to start into this entire currency diversification thing. Back in 1873, the U.S. was a non-player, obviously, in trade, and we were in debt after the Civil War and all of that. Things changed, but the reliance of commodities to anchor a monetary system and a national defense system exist, and other countries are very competitive on that basis.
Steve, got a question or want to jump in with a comment?
Blaine, one of our top fans here. Thanks for being here, Blaine. And also Z-Salt. Some questions on oil. Do you follow oil at all, Nomi?
I do.
Okay. Basically asking, do you think we're at a bottom yet in oil? Do you think it's got more to go down? Where would that fit into your 2026 prediction?
Yeah, so it's not in my top 10. And what I come to see about oil, and I think it can go down from here. I think we can have ups during seasonality and high summer ups and that kind of thing along the way. But there's been a structural shift, I think, away from not just using oil, but hoarding oil in terms of OPEC and production, or Russia and production, or who you're trading with, or whether Venezuela is going to give oil back to Chevron, back to the U.S. If there's tanker issues, there's so many things that are going on in oil, and there is an overabundance of oil, and we have enough oil. Not a price, just physical supply of oil around the world, and enough maturity in how countries stop or start or dispense or allow travel of barrels, that it's not as interesting an investment. And even the big oil companies from Chevron to Exxon and so forth are diversifying into different commodities. So oil is obviously important. It's still the base of a lot of different kinds of power. I mean, nuclear is sort of the 20% of electricity, so it depends how we break that out and what we're talking. But I just don't find it having a real upside. There's too much of it, and people get it. All the sorts of concepts about oil, going back to 1873, just one more time. Rockefeller, back in the day, new fact for me, instead of investing in oil, which, as we know, John D. Rockefeller, Standard Oil, big evolution, then bankers, etc. That's how he became a billionaire. He didn't invest in the barrels. What he did was he invested in midstream. He invested in refineries and processing and doing deals with logistics. And that's how he made money. And I think the margin, even this many years later, the margin in oil has been sort of squeezed out to the extent that even when we see strikes in the Middle East happen, we barely see a blip in oil. We would have seen oil double when certain things happened, or a tanker was stopped somewhere in the Middle East 10, 20 years ago. And now it's kind of a little bit of a blip. We talk about it and almost nothing happens. So not that interested in it as having upside.
Okay. Your energy play is uranium.
Yeah. Well, yes, on that basis.
Okay. What's your target? What do you see for uranium? You got it number 2 on your list, right after silver. What do you think uranium's in store for?
So I see uranium going to around a 110 level over the year, not necessarily out the gate. I know we're at 82 or something now, and the reason for that is that with uranium, again, so many different elements of supply and geopolitics. The United States just threw $80 billion of sort of subsidies into building out processing for enriched uranium. We had executive orders this year to accelerate permit processing and really help with the U.S. and allied supply chain. All of that has helped push uranium up because you have that other sort of anchor of financing. And similar things have happened around the world, the relationship between the US and the UK in terms of developing SMRs. All these things are happening in uranium. All of this has created some upside this year, but I think where the upside is really going to come as those policies continue is from the utilities that currently are using uranium as their baseload energy. And again, for us, that's 20%. It's around the same for Europe. It's a little bit less for China, but they're developing so much with respect to processing and SMRs and MMR technology and everything else, is that these utilities, they lock in forward contracts for pricing uranium out over a certain time. And so when we started this year, uranium around 60, let's say, in the beginning of the year, the utilities had already locked in a sort of 80-85 price for forward uranium. And so now what's happened is that time has gone and the spot price of uranium has sort of matched up what was the forward price at the beginning of the year. And that difference was about $25. So if you just look at that difference and not an addition of extra uranium added to the 80 or something it's trading at today, we're at a sort of 105. 110 is probably a conservative estimate, but I'm basing that on the fact that utilities are going to move up their forward price. It's going to take a minute, but that's going to sort of take the spot price along with it. And then, of course, we have these structural supply deficits as well. There's a lot of conversation that happens in the specific news about uranium that we don't actually have supply deficits. But if you're looking at a global reallocation to even an extra couple of percentages of nuclear, and we did the math on this at Prinsights, it's about $150 billion a year of just international government investment to get the uranium supply chain to the point where the promise of tripling nuclear energy by 2050 can even be a thing. And that doesn't include all of the extra uses in AI and data centers and everything else. That's just mere necessary growth to get to a triple of baseload use of nuclear for current energy needs. So on that basis, I'm talking myself into thinking 110 might be too conservative again, but that's where we're at right now.
Okay. All right. $110. Good deal. Good deal. Let's see.
But again, on all of this, and we're not, this is a whole other conversation for another time. And this is what we all do a lot, is look at, which mines and which processing and which sort of midstream companies are playing into all of these shifts. And that's a whole other level of, sort of leverage potential upside and risk, but potential upside.
Yeah. Yeah. You're on the board, going to rare earth elements. You're on the board of Meteoric.
Right.
Recently, they had I don't know what you would call it, a bad city council meeting or something.
Yes,
But maybe you can just give us a quick minute or two on what happened there.
Sure. So what happened about a month or so ago is our pit is in one area of the caldera, which is our project. There's an area called Pozos de Caldas, and there's Pozos. They're two sort of adjoining cities. And there was a vote in Pozos as to whether we could move forward with an environmental license. And what wound up happening was the way the votes were supposed to go in that the people that were on the committee for making that vote had said they were going to vote, just in terms of conversations with local government and so forth, would have given us that LP license, the preliminary environmental license that we need to continue to move on. And what wound up happening is one of those people, I'm going into more detail, but one of those people basically said, no, I changed my mind. Okay. And this was, and we put out a press release on this. The way this hit the market was kind of right at the vote, right as trading was, going to start the next day, and so we wound up just, having a pause to basically, issue a statement, everything else, which we did. The good news on all of that, fast forward to December 19th, last Friday, there was another vote, an official other vote. We did, in fact, pass that vote. So we did receive our preliminary environmental license, our LP, to move ahead. So that just happened on Friday. We did have an announcement out about that. So that issue is done. And I think in general, this is just something, I've experienced just firsthand with what happened in terms of local governments and local committees, and also the people on the environmental side, which is what it was, is that there are environmental concerns in any mine, and there are localities that have different opinions about them. And there's also mining companies that are better about how they treat the environment than others. And we have been backfilling. We have had multiple meetings with many people in the local communities, and we have a good relationship with them. And this sort of came as an outside to that, and the issue's been solved. And there are other mines like this as well. I think Brazil is really moving from requiring more environmental openness in the beginning, which we have, and also what the old sort of idea of what mines actually are, which is negative compared to, I think, where we're going. And of course, our pit is very surface, so those issues are less apparent than the Sebales mines.
Okay.
Hey guys,
Thank
we
you.
are running out of time, but there's one question that I wanted to address with our guests that I alluded to earlier in this stream, Steve, and that has to do with what some people think is an AI bubble. And there's definitely two opinions on this, because Joel Littman, who is a regular in the Rule Classroom, said basically said I was stupid to even ask that question. He backed off later, but he's not having any of it. But I wonder, because and this is going to sound far-flung, but when I hear these guys talking about what they want to do, like what it's going to take, and the hundreds of billions, and it's going to go into the trillions, right? Like eventually, year after year, if it's like this, the amount that Oracle is borrowing to do this, so it's not even coming out of earnings, it sounds desperate to me. And it sounds desperate. I don't know if you know the history of Mao's Great Leap Forward, but it sounds like that type of desperation, and that type of industrial build out, if it fails, results in so much suffering for someone. And so, guys, I just want to ask you, what do you think about this? Like, does this look healthy to you? The what's going, not just the rise. People make it about NVIDIA. I'm not even talking about that. Just the amount of borrowing, just the hoarding of capital resources at a time when, like our roads, our bridges, our schools, our hospitals, like society needs so many things, right? And all of this going into data centers that if it doesn't work out, what good are they? And who wants to answer this first? I want to hear from all three of you on this one.
I can go, Albert.
All right. Yeah, let's go.
So I'm an engineer, and I've helped create a concept that actually tries to use waste heat from computers to make usable hot water, either for commercial or residential use, right? Wow. So a big problem with all these data centers is that at least half of their power consumption is used just to keep the servers cool. Sometimes more. It can be, there was a video of Elon talking to Jensen, and they want to put AI servers into space next. Right? I mean, maybe not next. It's going to take a couple of years, but they're like, yeah, it's great because there's free solar power, and everybody knows space is cold, so you can just get rid of the heat that way. It's far more complicated than that. Space is a terrible heat sink, turns out, but I don't want to give you a physics lecture. The bottleneck everywhere for AI is not going to be GPUs. It's not going to be data centers. It's going to be electrons. So how much excess power do we have on the grid? In the US, the answer is 0, right? In Europe, the answer is probably -10, because they're actually actively taking capacity off the grid. The US is not quite that bad, but it's close. And in China, they're building everything. They're building renewable, they're building non-renewable, they're building quick, what do you call it, fast-acting gas power plants that can be used to buffer. They're building tons of nuclear, which of course the build cycle is long. But so if you're asking, like, okay, well, who's going to be the winner in that race? It's going to be the one with more electrons to spare. And then because I think the efficiency of the GPUs that currently NVIDIA is leading by a large margin, I don't think on a longer time frame it's going to matter. Because if you can't turn them on, what good are they, right? And you can always find more efficiency in the software, which has been proven over and over again. So in the last .com bubble, what was it? I forget the example, but there was something about a fiber build out, and then somebody invented a multiplexer, and all of a sudden you didn't need all this fiber capacity they built, and there goes billions of investment. They were projecting how much money they're going to make, and somebody said, well, now with this piece of fiber we can do 100 times more, and they're like, crap. Because the price just was divided by 100 all of a sudden, the revenue they could make from it. So I think the question is completely justified. Does it make sense to invest all this heavily in this infrastructure? I don't think it is. At the same time, the private companies that are doing it, those handful of $1 trillion companies in the US, I think they're all going to do it. And I think they're going to profit from it greatly. So I wouldn't recommend, if you have them in your portfolio, to sell them. I don't think that they're going to have a disadvantage from it anytime soon. But it's super hard to know what's going to happen when they really enter this like exponential age type growth thing, because it'll get more volatile, right? But who can pick the winners? I have no idea.
Yeah, maybe I can just follow up with from where Lovis left off, right? I agree with him. I think the bottleneck will be electrons. And say we look at EVs, right? I know it's not a perfect analog, but the Tesla was leading that race for a long time. And then China just, like that. You go there now and there's 8-lane highways and you don't hear anything because everything's just electric, right? Mm-hmm. And when I'm working there and traveling there and I'm asking questions, very quickly you realize when they tell you they're paying 3 cents for a kilowatt hour, and that's the retail price, and if you're a taxi driver, you're paying less, everything makes sense straight away, right? Like, so I'm from Singapore, and the government there has been trying to get people, they've been making promises, hey, we're going to go EVs, but they can't get that electricity distributed, and they don't have that volume, right? And so as much as they're trying to get everyone to go towards EVs because it's, we're a green city, it's much cleaner, etc., it's just so hard. How are you going to get all the chargers where you need them? Where's the power going to come from? And how much does it actually cost? Does it make sense for the driver to drive an electric vehicle versus pumping, petrol that's $3 a liter in Singapore? That's like 3-4 times the price of what it is in the US. And yet EVs aren't as cheap, really, when you factor everything in. So I think just to double down on what Lovis said, right? It's really gonna be about electrons, and because that's the first thing you need to even say, I'm playing the game, right? And so maybe the next penny to drop will be, hey, in the States or in Europe, we need electrons now, so we definitely need more nuclear power, coal power, whatever, solar power. So then maybe those industries will catch a leg up, and let's see.
So, and I agree with you guys actually, but the question was not really that. And this is going to sound like I'm one of those those China watchers, but the question I'm asking is kind of at what cost? So if energy is the issue, they will find ways to make the energy, right? Or we'll take it from somewhere else. But what I'm worried about is that the so-called AI bubble that's going to pop, it might not pop in the AI sector, right? Like it may starve some other sector of the resources it needs, and so the disaster is just going to show up somewhere else. And so you might get your all your data centers But like I said, at what cost? And if you're wrong, if the return is not there, then it's a catastrophe.
Yeah.
So
is that what you meant with Mao? When
Yeah, I mean,
everyone was donating their pots and pans and everything just so
exactly.
that they could
Exactly.
pig
Tremendous
iron,
societal sacrifice for this mission. And if it fails, in that case, there is starvation. Right? And the British Empire was the same, only the people that starved were Indians. But it's the same thing. Like, if you're going to hoard all this capital and deploy it, and you deploy it in a way that doesn't return, then there's going to be massive amounts of suffering. And so that's what I'm afraid of. If we go all in with this AI thing, which I have confidence that they can do it. And if they have to solve an energy problem, I have confidence that they'll do it. But what's going to be the consequence of that?
I just to jump, I think that's a very valid concern when you talk about data centers. Obviously, and I agree with you guys. I totally agree on the electricity thing. I mean, the reality is that electricity is a very important commodity that's kind of ancillary to most of these other commodities. You know, whether they form a battery or magnet or building an industrial site or whatever it might be, copper wires, etc. It's all connected except maybe gold. But I think the data centers themselves, yes, there is a lot of money being deployed on the public sector as well as from the private sector, obviously, to build the centers themselves, and also the people that labor and stuff is there as well, and then also to create a grid that can accommodate what those data centers represent. I actually think this is not what you asked, real quick. I think it's not just about AI. I mean, I think, again, this is one of those things where it's convenient to call it AI. It's any form of data analysis, whether that's for medical reasons, whether that's for defense missiles, whether that's for streaming. I mean, we are so embedded in data that whether there's an AI component or not, which will also grow as so forth, the crunching is necessary, the energy is necessary, electricity is necessary. Also, our grid, to Lova's point, our grid, Europe's grid does not have the capacity, and it hasn't for decades. So on the one side, if AI or data centers can move that needle forward on requiring more focus on the grid, which has been dilapidated and crumbling for so many decades, I think it's a positive. The problem that you're talking about, Albert, is also that if you move that power, if you create that infrastructure in the locations where the data centers want it, what other locations aren't getting the appropriate infrastructure, whether that's better electricity, whether that's putting wires under the ground as opposed to over the ground, whether that's better water systems, better roads, better everything else, because you're basically, it's locational. It's not just the data center needs it, but the data center in Northern Virginia needs it. Right, because Northern Virginia is one of the biggest sort of data centers in the world areas, and that takes resources away from potentially the same electric grid, but somewhere in the middle of Iowa where there isn't a data center. So I agree that there's a cost in terms of whether it's electricity or just general infrastructure funding of funding these data centers in their locations. I also think it's necessary to fund them, and the infrastructure there will be useful for those locations. So I actually have been in a lot of conversations with local politicians and state level politicians about that very issue. If we know we need a grid, we know there's a very high power, high player sector that is pulling that demand, and that's in some ways a positive because it can funnel down. But how do we also reappropriate or examine where there's other needs, whether it be for electricity or always other kinds of infrastructure, which the U.S. is woefully behind on, to sort of balance that out. I think it is a real concern, and I think it will continue to be a concern. I would personally move some of the profits into maybe more diversified infrastructure building, not just related to the data centers, which again I've been in conversations about, but very valid.
Nomi, if some of these companies get in trouble down the road, and these data centers are not worth what they thought, could you see the possibility of the government coming in with, like from the real estate crisis, the troubled asset relief program, and actually some government entity ending up holding these like data centers on the balance sheet, and would the public go along with that after what we went through in 08, 09?
There's certain things that the government's done on that basis, like try to invest in Intel. The whole sort of chip war aspect of subsidies from,
great example.
From the Biden administration, but also then in a different, form of words, the Trump administration, in terms of trying to get a sector effectively, not nationalized, obviously, but, just to have some form of funding coming from the government as well. And so I think that can happen the same way there can be an agreement between U.S. Steel and Nippon to sell off, portions or sort of reappropriate partnerships, through big, in big steel missions where steel prices are at risk. So I think that can happen. Whether they take over the actual running of the data centers, I don't know. I see it more as are there subsidies? Are there tax breaks, which there already are? And how is the government involved? And right now, the last government and this government are very much pushing the build part of it, and the support part of it, because it's competitive, relative to China, relative to just evolution of AI and wanting to own that in the world. I can definitely see if things really fall apart, them throwing 5, 10, 50, whatever $billion into one of these ventures. Like, for example, I'm not saying this will happen at all, but if you look at something like Palantir, which has just zoomed up, and we recommended Palantir and another sort of formation, like $17. It's now like 185. I don't think that's the high, but it also has multiple contracts with the government on multiple levels. So if there is an issue where it can't function because of some sort of implosion of AI stocks, like .com, through all of them, the government could very likely step in and sort of boost up the elements that it needs of this company. So I think we see, we can always see segmented support. I don't know if we would see like a nationalization of data centers, but we can definitely see if there were to be something like that, the ones that are most important, from a sort of strategic sense, being supported in some manner.
Albert, if I have another thought that came to me listening to Nomi, if I may, I don't know if we're running out of time.
Go ahead.
Or not.
No, go ahead, Lovis.
So you and I, Albert, have talked about basically what do you call it? Going into a post-scarcity world, right? So maybe I don't think that AI itself can deliver that. At least, I mean, it's too many ifs, right, to get to that. But what really impressed me was that, for example, nuclear power was so unpopular in all of the West, right? In the US, slightly less unpopular in the US than in Germany, for example, but still there hasn't been new plants built, I mean, I think there was one now, right, in the last 50 years or something. But all of a sudden that's changing, right? So what Microsoft wanted to build a new data center. So then they're buying up a defunct nuclear power plant and they're working very aggressively to get it restarted. And, all of a sudden then if basically something is declared to be the AI arms race, right? So that makes it sound like, oh, this is all defense relevant. And if it's defense, then it gets done, kind of a thing, right? And I don't really like that. I think that thinking of AI as a weapon already sets us up for, Terminator, basically. I think that most of AI is not a weapon. I mean, it might make you stupid if you use it too much, but that's about it. But what I like about it is, though, I think that more nuclear power plants with, all the proper licensing and regulations and everything in place, designed by smart, established engineers, etc. I think more nuclear is a good thing, because I think it'll drive down power costs, right? And so having cheap, abundant electricity anywhere will lead to prosperity, generally speaking. Is it going to be in the right place? I don't know. But if the grid's good enough, then that should have pretty wide radius around it anyway, where that could be a benefit. Even if power would just be cheaper during certain off hours, right? That could still be beneficial to other industries. if it basically helps cut some of the red tape, all this enthusiasm of the tech companies who, in my opinion, are making policy, right? Usually what the tech bros want gets done. And if they all of a sudden want more, more power, better grid, all these things, then I think that a place like the US can benefit from that. Whereas before, when it was like the only acceptable answer is solar and wind, I don't think that brings about the same prosperity for many reasons I could go into, but I don't want to bore anybody to death. And then, with the business model, et cetera, like that's kind of the other question. Will that ever pay off? Well, if there's excess capacity for AI and all of a sudden nobody wants it anymore, I think there's still tons of ways to make money out of data centers, even if they're not actually doing AI. Right? I mean,
well, there are. Okay. So Mark Zuckerberg addressed that in one of his earnings calls, but it sounded very lame because he says, "Look, we're acquiring compute as fast as we can, and if it turns out we don't need it, we'll just use it for other stuff." But that's like buying a Ferrari and saying, "Well, I'll just take my kids to school in it. If I'm not a world-class driver, then I'll just use it to take my kids to school." It doesn't make sense to buy like a high-end, quickly depreciating item if all you're going to do is have it. Who knows what Meta would do with it? But if it's not AI, it's suicide, right?
Yeah, I mean, I think what's cool to see is that one of Zuck's big plays with the metaverse does not seem to be catching wind nearly as fast as he had hoped. And it's, in my opinion, as long as the damage is confined to, the formerly FANG companies, they have so much cash, let them burn some, right? Like I don't think that could hurt. Honestly, if they come back down to earth a little bit, I think people would benefit from it.
Yeah, I think Oracle's sucking pretty hard on the debt market, though. And if it does come to a bailout, then that's us. I mean, we like this inflation.
Right, I see. I see what you mean. I see what you mean. If that's, of course, if that's the case, more bailouts, then and interest rates and whatnot.
We're over 4 hours, guys. So thank you. This actually flew by for me, which is I didn't think I was going to make it. I think I was going to bail out and leave Steve alone, but this flew by. So thanks a lot, guys, and everyone in the comments and whatnot. Thank you very much. We had great questions, great comments, and hope to do more with all of you next year. Oh, before I let you go, actually. Nomi, you've been a favorite speaker at the symposium for many years now, and we're looking forward to having you back next year. So I have to mention that the team is putting on a special deal for the July symposium. If you go to that link, use the discount code RULECHEER25. I think it's a $25 savings on admission to the conference. So let's see. Let me put that up again. Symposium.ruleclassroom.com. So please use that code if you want to hang with us in Boca Raton. It's always really fun. And Nomi, you always do a spectacular speech. So I'm really looking forward to seeing you there again.
Thank you. Me too. And everybody who shows. It's such a great event.
All right. Well, thanks very much, Lovis. Jason, keep up the good work on the podcast. Look forward to more from you guys in 2026, and I hope I get to see you in person again.
Yeah, hope so.
Thank you so much, guys. Thanks so much.
All right, thank you, thank you for causing this to occur, Albert.
Spoken like Rick Rule would have said, exactly like Rick would have. Thanks for hanging out, man. They dug your hat.
Yeah, they like the Christmas hat.
Yeah, they love the hat. We had great questions. I'm just looking through them now. We have still with us almost 5,000 people.
Awesome.
So thanks, guys. I saw that some of you reposted the feed. So that was great. So yeah, great year, Steve. Appreciate all your help in Rule Classroom Plus. 2026 is going to be great. I'm really looking forward to it.
Yeah, me too. Yeah, Rick and I have our next Q&A coming up in the Classroom Plus on January 8th. And then a couple days after that, we got the Golden Triangle Boot Camp. So a lot of exciting stuff coming up in there. And I'm thrilled to be a part of it.
Golden Triangle. Oh, thank you for reminding me. Golden Triangle Boot Camp, January 10th. There it is. There's the link. bootcamp.ruleclassroom.com. That's going to be a fun one for a change. Instead of focusing on a mineral, we're focusing on a region. And so it's going to be specific sort of discussion on assets, sort of geological characteristics, and talking to people who raise capital for projects in that region. We have people who can discuss sort of the social and political considerations and all those things. So this is kind of this is a new one for us, but I think it's going to be really, really popular. So yeah, bootcamp.ruleclassroom.com. Steve, we went over almost 4.5 hours, buddy.
This is the longest podcast I've ever done. I've done a 3-hour one before. I've never done 4.5.
We only exhausted one person's battery. I'm a little bit discouraged. I thought they'd be dropping like flies after the first one went, but they must have had backup.
Yes. Well, thank you, Albert.
Yeah, thanks, Steve. I'll see you again soon, buddy.
All right. You have a great rest of the day. Thank you for everyone for being here, and you guys have a wonderful holidays and a happy new year.
Take care.